Howdy, it's Mike again, and man, what a crazy week we had this week. I'm recording this on April 5th of 2025. If you're watching this another time, but man, what a crazy week! I'm really hoping that you know I was in cash this week. Not saying any, like, well, I did some day trades, but was in cash this weekend. I think if anyone was watching these videos, you probably would have been in cash as well. And I kept swing trader in cash as well because I just didn't want. I know people, follow along. Well, that's what they're intended to do, and we kept that in cash as well, just because of the setup. And if you got hurt this week, um, that's okay because we all get hurt all the time. And I've been hurt, brutalized, man. I've been so low, I had to look down to look up. So we've all been there, and you will get to the other side, and you just have to study more and research more, and then try to make not make the same mistakes the second time, but you'll make different mistakes. I make 51 and a half mistakes a day, and I just try to not repeat the same ones if at all possible. So that's a lot of what this series is about, is just trying to help all of you out to make fewer mistakes in that learning curve. Because when I started, I didn't have anything like this. There was no YouTube. There was no one to help, no one to hold my hand, no one to give me any encouragement or advice, really. Frankly, it was just do it on my own. Get books like Reminiscence of a Stock Operator and Jesse Livermore's How to Trade in Stocks, which are really the foundation of how I look at everything. And then, of course, you know, Bill's book, yeah, I mean, that's a game changer. How to make money in stocks, So, with those three, that's pretty much all you need. Plus, I would say the market series wizards, or the market series, all of them, the market wizard series. I don't know what I said, but anyways, from the very first one where Bill was in, and that's my favorite one. Marty Schwartz was in there at Dakota, and that one was great. The new market wizards and all the entire series, I have them on audio, and I just listen to them over and over again, because each person, even if they trade completely differently than I do, which they pretty much all do, that you can pick up different things from them, even if they trade a completely different style. And these are the best around. And yeah, just that series, of course, Darvis's book, How I Made 2 million in the Stock Market. That's a quick, easy read with some just very basics. So that's what you should be doing. And you'll still make mistakes, because I've read all those and I make mistakes all the time. And I saw Bill making mistakes all the time. So don't get down. I guess what I'm saying is, if you're watching this and you had a bad week, you're not alone, because hundreds of thousands of people, probably millions of people, got really hurt this week. And so your goal is to try to learn from the past to be out of the market when we have weeks like this. And um, so that's part of it. Now, what we're going to be talking about today is a few things that are very important. This is probably going to be the most important one that we've done so far, and that is looking at other times in the market where you have big hits like we had today. I'm going to be doing my research that I was planning on just doing on my own. I'm going to be doing it during the show and walking you through that. It'll take me longer to do it that way than if I was doing it on my own, but I think you guys will benefit from that. And it's how I've always done things, going back to the 90s. When I look at a certain setup in the market, I look at history to try to see, were there any other times like this? Because most things are not unprecedented. You have a guide to go off of, and most people have noticed, or like, just don't even think about the history, that we have. And we're so blessed to have history in the market going back, depending on what database you use, back to 1880 or 1900, or even if you're just going back to 1963 or the 70s or 80s. still a lot of data that that's what we need to leverage off of, because technical analysis are not a bunch of squiggly lines on a chart. That is fear, greed, and hope. So it's just mass psychology every day between that bar. Where did it open? Where did it close? How high did it get? And how low did it get in relationship to its recent past and its intermediate term past? And that's what we have to go off of. That is the fear and the greed. And we saw a lot of fear this week, and then eventually when the market looks like it's bottoming, which could be Monday, it could be 3 Mondays from now, it could be whenever, that people will go in there, and then that fear will quickly turn to greed, because everyone will want to, buy the bottom and get this big move off of there. And then, when it starts rolling back down, if it's not the real low, then they're going to be hoping that it's going to turn back around, and then that's going to go back into fear. So you just have this cycle of fear, greed, hope, fear, greed, hope, over and over and over again. And our job as technicians is to interpret that the best we can, and not to predict, but to know what would be normal and natural on the next bar. So then that way, that will give you confidence to either play long, short, or nothing for that next bar, if you don't have enough information, that would tell you what would be normal and natural, or if what would be normal and natural on a risk reward basis doesn't make sense, then you don't play. And that's what we did, this week. Like I was saying, like with Swing Trader, we had it in cash because risk reward did not make sense at all to trade. Anything other than, some little scalping day trades here and there, on like inverse ETFs and things, or intraday bounces in the market. I mean, I just do that because I'm in front of it. Really, I shouldn't be doing any of that stuff. I mean, gives you a little bit of, well, let me take that back. It does give you feedback from the market. Like you put on a trade, and if it works, it gives you feedback. If it doesn't work, it gives you feedback. But really, the odds are stacked against, unless you're a day trader, which I'm not. Like I really shouldn't be doing anything other than just sitting in cash. But I'm a junkie. We're not perfect. Okay, so this series, let me just share with you, if this is your first time with us, we are going to I just want to point you in the direction. I would probably actually start with today's episode, even if you haven't watched anything else. I would watch today's. Then this is my, hold on a second. Let me move this around a little bit. So this is the Webby 5150 YouTube channel that I have here. We started off with a precedent analysis, which is really worthwhile. And that started off by looking at the December 18th bad break. So it's going to be somewhat similar to today in some ways, because we're looking for precedents, but that's a really, really good one to do. But after today, what I would suggest is you go to number 9, which is the 21-day as a part 1, which as it relates to the general market. I will do a part 2 and 3 and 4 and stuff as we have time, and I'll do one on individual stocks because I know a lot of people have asked for that. Then we'll do. Then you should do the number 10, which is the follow through days, part 1, and then the number 13 follow through days underneath the 200-day, which was part 2. So again, number 9, number 10, number 13 would be how I would do these, and I would actually watch those several times. Then the rest of them, just whatever is interesting to you. I go over how to build a model book, and I'm going to have a massive model book series. We've already done Cisco. What did we do? Cisco, Apple, Google, with the Google one, which was number 8. I also went over how I invented the IPO base using the Google as my main model. Then other things like just how I like to use market surge, but why I created the number 4 is why I created the composite rating and how to use it. That was actually Bill's favorite rating that we had. So I was very proud of that. Then how and why I developed the growth market surge growth 250 and how to use it. That's a really good one. Number 12 was how and why I created market surges 3-month and 6-month relative strength and how to use it. Let's see what else we have. Oh, my favorite one, my absolute favorite one that no one watches is the fear one. That one has nothing to do with stocks, but everything on how to deal with fear, or how I dealt with fear. So I'm going to stop sharing that and get back to this. So as I say each time, because it'd be like, why is this guy rambling on about all this stuff? I wanted something out there to help everyone, but I also wanted something to be left around for my kids who are 23 and don't really, they're twins and they're starting their career. They've graduated college and, they don't have time or the interest to learn how to invest. And it's nothing I ever talked to them about. Well, a little bit growing up, whenever they showed interest, we would do stuff. There was this old chart arcade that we used to have at Market Surge that was really poorly developed. I had nothing to do with it, but it was terrible. One of the worst. I'm sorry we don't have it anymore, but I'd love to redesign it from scratch. And it was basically like a game of a pretend game, and it would show you a random stock, and you would say, okay, you're going to buy it or short it, and then you walk through not knowing what it was, what the stock was until afterwards, and it would really train your eyes. And I used to use that a lot. I would do it after my Sunday night calls with Bill. It just as a way to kind of getting myself into a routine. And I tried to do 15 minutes at a time, and it ended up being an hour or so. So I'd have to pull myself away. But my daughter would play that, and she has like zero risk tolerance, which is totally fine. Like she doesn't want to take, wouldn't want to take any risk with capital. And that's totally fine. She's going to be a school teacher, and that's going to be her gig. And it's something she always wanted to do, a music teacher. And she's like a little me, like just a super hardcore workaholic. So I hope if she watches this one day that she's actually slowed down and is relaxing and enjoying life a little bit more and not being so much like her dad. And then my son, who's just a freaking genius, he traded crypto for a while and some stocks, but he's just not into it right now, and that's totally fine. But it was to have something for them, and then if I'm not around for whatever reason when they have kids someday, I wanted to leave something for my grandkids. And I realized that I've developed a ton of intellectual property for William O'Neill and Company and IBDE and our other sister companies and their sister companies. And, without my name attached to it, I never like spoke up and say, oh, hey, I built that and I built that and I built the other thing too. And so, even people I work with have no clue what I've really done. And I had forgotten a lot of it, frankly. And so I'm like, how are my kids or grandkids ever going to know if my current coworkers don't know what I did? Like, and I just want them, you want to leave a legacy for your kids and family and all. So that's what this is all about. And I was going to just record them and keep them on a computer and leave it, in my will or whatever. But it's like, oh, what if it, like something happens to her, they can't figure out the password or whatever, gets lost. So I figure YouTube will be around in one shape, one way or another in the future. So that's what this whole thing is about. Anyways, watch these. I could be charging a ton of money for probably all these episodes except for the fear one, which I think is actually the most valuable. And I'm putting this out there for free for folks because I know when I started, I did not have a dime to spend on education, even buying books. That was what I told my parents, I wanted for Christmas back in '95. I remember I was like, all I want are investment books, and that's when I got Bill's first copy of this, and that changed my life. And so that's what I'm trying to do. Just pay it forward, and strong believer in karma. So don't know what that was all about. But anyways, let's get started. So this week, what we're going to be doing is going over the worst weeks in history in the market, because we've had one of them this week. And what I like to do, as I was saying before, is just try to find precedents, try to find what would be normal and natural post a crash, which is essentially what we have this week. So we're going to walk through how I would do research, and if we have time, I'm going to give you my take on any secondary indicators. If we run out of time, I'm going to have to keep that for a separate one, but it is very important. So I'll try to make time for it. So let's get started here, and I'm going to share. Go back here, and let's share. Where was it? Okay, so I went into chat now. Let's see, the Grok was better. I went into Chat GPT as well as Grok to just find these, because I didn't get a chance to ask Justin for this list yesterday, and I didn't want to bother him over the weekend. So I was looking for the 50 worst weeks in trading history on the NASDAQ, and we have it in chronological order here. So this is according to them. I also kind of was cross-referencing with ChatGPT, but here they were missing the 70s, even when I specifically asked them for it. So if I was doing this at work, I would be trusting Justin's data to make sure that we got it all right. But we're going to look at these. So we're going to do it chronological, go 1973 on, forward. Now we might not hit each one of these, but we'll see which ones make sense. So we're going to start off in November of 1973. So again, these are the worst weeks in history based on a percentage basis for the NASDAQ composite. So wait, let me stop that share. Okay, just got to get my screens oriented. Probably should have done this ahead of time. Let's see, share screen. I know, terrible at this. Okay, so hopefully this is good. We're gonna look at the NASDAQ. So this is our current week. So let's just kind of go through what's happened here. And I'm trying to keep these not specific to what's going on in the market right now, because that's what I do a lot of at IBD. I'm on IBD Live every Monday, Wednesday, and Friday from 10 minutes before the open for like an hour and a half. Once a month on Tuesdays with Justin, I do the Swing Trader update that's free, and that's on YouTube about an hour after the close on the second Tuesday of every month. So the ST, second Tuesday, Swing Trader update. So the STU. And yes, I did pick that day because I thought that would be kind of funny to have an STU, because that's how I roll, because I'm a geek. And then on Friday, my favorite time, with my buddy Ali, we do the stock market today right after the close, about 5 minutes after the close. That's free, and that's on YouTube, and that goes over that week's market and kind of where we are and everything. So if you're interested in the current market stuff, that's where you can find it. That's not what this is for. This is really for things I don't have time for to do during work, and I wouldn't want to waste everyone's time, especially when I'm rambling, because they'd be like, Mike, come on, get with the program, let's get this over with. And I hate it when, if anyone ever watches, I hate it when you do that, so don't do that. But anyways, let's see where we're at. So we were in this is December 18th. That was when Powell came out and kind of switched gears on Fed policy. that day. You can go back and watch that. I watched that one, I think, 6 times that night, at least 4 times. And it was really a game changer, if you know how to read in between the lines of what Powell says. And then we've had a few other ones since then. And we were coming down sharply. We had this follow through day in spirit on this day on March 24th. And look, I don't care what anyone says about the volume on that day. That was the day after a triple witching day. So the volume was artificially high on that Friday. So if someone says, oh, that wasn't a real follow through day because, the volume was less than the prior day, they frankly don't know what they're talking about. And if Bill were around, because I called follow through days with him for about a decade and a half, and he definitely would have called that one. He would have made the exception on that volume. So that was a legitimate follow through day. And then if you watch the video that I put on follow through days, you'll know that this signal here on March 26th, let's just go back there. That was something that I developed with Justin and Chuck when we did the IBD's market school rules, where through original research or just studying all the follow through days and trying to get out before you got all the way down here, because that was originally with Bill's original rules. That's when the rally would have totally been dead, is you get your follow through day here and you don't know to exit until here. And we just realized that was just not good. So we tried a bunch of different things and found out the best thing was just a close below the low of the follow through day as your exit. Now you can always then get back in if it firms up, gets back above the 21 day or has a different follow through day. But so you would have been in, and I was in. I went in heavy actually. I actually went in heavy here because it was an upside reversal on Friday, and we put, I think we put swing trader to 25% invested there, and I think we got up to probably about 80 or 85% around here. Then had to back away. And then we tried like another day because intraday here from memory, I would have to go back and look. When it was intraday at the highs, it looked like it had closed this gap here, and it was going to be an upside reversal. And so we were trading that, but then we had to back away right around the open on that day. So we got out around there with what we would put back in. So I would frankly, you go back and you study your trades, and sometimes you go, wow, God, what was I thinking? I wouldn't have done that, But if you put yourself, your intellectual honesty hat on, which is the hat you should always be wearing and never take off, I did the exact same thing, the exact same way again, because that's what using the information you had at the time, what would you do? And that's what you always want to be asking yourself, not knowing that we fell apart. What would you do? But, getting in here, adding here, getting out here, getting in a little here, and getting out there. I would do it all over again. And if you have a better way of doing things, dude, run with it. Do it. That's, like there's a million ways to trade. And I know a lot of people, who, do really well buying off the bottoms and stuff. And, that's just not really my style, but if it's your style and you can make it work, do it. So then at this point, really at the close there, the way it closed, we don't like to remove things in the last 15, 20 minutes of swing, or really even the last half an hour on Swing Trader, because we want to make sure people have a chance to actually do the trades. But if we didn't have that rule, I would have just sold what we had bought on this day because it was breaking my expectations, closing near the lows there. So besides, some day trades or whatever in here, there is no reason to be trading at all, because we're waiting for a follow through day. So first we've got to get a rally day, which this was a rally day. And then, you can watch the video on the follow through day, or I'm going to get derailed for like a half an hour going on that. But that was your rally day. This was your follow through day. So we need a rally day. And then 4 days or more from there, you need a big move up. And for details, watch those two video. So this is what it looks like on the daily of where we're at right now. Let's look at it on a weekly, which is telling you how much devastation. When you can see this much, I mean, we're down 10%. That's a crash, really, you know. Let me put this on here. All boxes. What happened to my okay, so like the Qs are 21.8% off their highs. Not sure why we don't have the NASDAQ in there, not off the high. But you can calculate it. So, you know, down 10% in a week. We've, you know, undercut this area. We undercut the 16,000. And of course, as I got several comments on this week, we even went through 5150 on here. So that would have been what, right around there. So even 5150 couldn't hold. So that's a crazy market for you. Yeah, like one person is laughing. All right, so let's go back to the NASDAQ and let's go to that list again. So we're going to be going back to 1973. Oops. And unfortunately, our data here, we only have closing data, and there's a lot of bad data, frankly, in the database. And I'm working on getting that cleaned up, but it's a lot harder than you'd think. Okay, so here it is, our first time that it's our worst week, and let's go there. So we were coming down that week, you're down 4%, and this week you're down 4%. The week before, down 2.9, and then 3.4. So week after week, you're coming down. But how this is in a different position is you had already been in this really terrible 73 to 74 bear market. And I got to tell you, during 2007, 2009, that bear market, I got obsessed with because I realized it wasn't like the 2000 to 2002 .com. And it also wasn't like the 1929 to 1932 market. So I was searching for something else. And so I got fixated on 1973 market. And maybe we'll do an episode on that and what I found, because that'll get me derailed. I'm trying to, we have so much to cover today. I'm going to try to stay on point, but you know, famous last words. Okay. So how do we do this research? You look at the week in question. So what we've got here, and then you say, okay, does that look like our current setup? So let's go back to our current one again, and let's get this fresh in our mind. Okay, so this is what our current market looks like. And you want to get markers in your head. Okay, you've been having this, you start off with like the major markers of where were you? Like if you were to just draw out the chart with like a crayon on a piece of paper. Okay, so you have this, you know, bull market. Why does this look funny? Huh. Okay, this bull market here, little flat base that it tries to break out of, and then you're going straight down. We can even look at it on a monthly basis to kind of see. You got 3 months down 4%, down almost 10%, and down almost 10% for those months. So that's what it looked like. Now we're going to go back to the daily to just see you're kind of in this free fall, but you're underneath the 200-day, and the 50 is just starting to come through. So that's kind of our point of reference is when that 50 comes through the 200, not as a signal. You know, people call that the death cross and everything like that. It's just that it's a very late signal. You would never use that, or the golden one, you know, where the 50 goes through the 200-day. But it's just it's kind of like, are you above your 200-day or not? Is your 50-day above your 200-day or not? Is your 21-day above your 50 or not? You know, things like that, just a point of reference. So your 21-day is underneath your 200-day, your 50 is going to be crashing through your 200-day, and your 200-day is flat. So now let's go back to 1973. What was that? 11, 23, 1973, and see if that lines up. So no, because it lines up more over here, right? Because your 50-day, let's just go back there. So around February 20th. Let's go to the 23rd. Okay. So this is more of where we would be, even though it didn't make it with that from ChatGPT and Musk's Grok, which I actually prefer that. So this looks more like it, right? Because you were in this bull market, you have this little kind of flat base type of thing up there, and then you fall from there, and down 3% for the month, down to, and so not as much devastation as before. But look at that. That 50-day is just coming, about to come through the 200-day, and your 21-day is going straight down. So that's more of what we're looking for a precedent. So then our question is, what should we expect for the next month? Let's just keep it simple for this one. Really, when I'm looking at it, I'll look at months, 3 months, a year, and so on. But let's just keep this simple. And when we find a precedent, let's just go out a month. So we're on that week. We're going to go 1, 2, 3, 4. Let's just go to the 23rd of the next month. And what had happened? Okay, so February 23rd, we're here. And then down there, a month later, we haven't even gone back above our 21-day. And so if you don't do anything else, watch the 21-day video, and you'll see how powerful that is. Let's go out another month. So we're going to go to around the 23rd of the next month. Wow. And that's down again. Never going through the 21-day. Let's go out another month. Still, same thing. This is not looking good. Let's go out to the 25th of the next month. Still, you get one little poke above your 21-day and right back below it. You see why I was so fascinated with this market. We'll go out to the 23rd there. Okay, so it's finally starting to poke up, and let's look at it on a weekly to get a sense. So you've been going straight down. Now we're finally trying to bounce, and just go out another month. And then it's just too soon. So our first observation, you might want to be taking notes, is our first observation is your first attempt when you're underneath there for so long, for a prolonged period of time. Now, we're not under it for a prolonged period of time yet, but this is just stuff that you're putting in the back of your mind, or actually taking physical notes, that it's too early, but at least it's slowing down, and you can see it gives its 50-day a chance to flatten out, and its 21-day a chance to increase. And so the distance between your moving averages is getting closer. So you know that you're closer to the bottom, but you might have another leg down. Let's go out another month. Okay, so it's kind of flattening out there and moving back up, but we're still under a really sharp, let's just go out to the end of each month. Okay, we come up to our declining 200-day and run into resistance there. That's normal and natural. You're just making mental notes, what's normal and natural. Then it falls back below. And what is also normal and natural is when it can't hold the 50, all hell breaks loose, right? And you see that right there on November 2nd, falls through, and then look out below. So that was the week. So this week here was the week that was like our current week. So we're going to go back, and that's our current one, that, or at least it's our first in our sample. So November 19th to 23rd in 1973 was one of the worst, and that one was down 4%. Now, you might say, well, we were down 10% now, and that was only 4%. How is it comparable? But it was a much tighter market back then for NASDAQ. The wiggles and wobbles on a daily basis, or put another way, that their ATR was different, much lower back then. So we go out a month, this on a weekly. Let's go back to a daily. So here was the 23rd. So this was the day in question. So we still go lower. Now we're finally get back above our 21-day there. Let's go out another month. And you can see you get above your 21-day, but you're still well underneath your 200-day. So you need more time. Let's go out another month. And you just need more time. Let's go out a few months. and then it can't get back to the 200 day. And that's why I always say, like, once you're underneath the 200 day for a while, it is a big deal. You really need to dial things back, and you can't be getting aggressive, even with follow through days and even with getting back above your 21 day and everything. Like, you need to temper things until you get back above your 200 day. Let's go out another month and just lower and lower. Okay, let's go to the weekly, just a point of reference. So we were first looking around here, but our first date on there was this week. Okay, but we went and started looking over there because it was closer to where we're at. So this was when things started accelerating down to the downside, and look how much worse this gets. Let's just go out. Let's go out to the end of the year, because at this pace, we'll never get done. So it just keeps going. So again, our point of reference, we were looking over here, November 23rd. So then this was the week in question. So mental note, this does not look too good. So then eventually you come out of it, but that'll be one for another time. But let's just go out just so you see that everything does come back around. We'll go out to 77. So you finally do bounce here, and this part is very important, where you come back and you pull back, but you hold above your original low. So notice here, you did that here, which this was constructive, but then once you went back underneath those lows, it was all over. And the same thing here, you hit a low, tried to hit a higher low, but then once you undercut that, boom. So that's really, pay attention to that. So in this case, here was your line in the sand if you were trading there. And then you could see once that held and you go back, well, let's just go back there. January of 5. Okay. So okay. So again, we bounced up here, came down, but we held above our original low. So now when it comes back through, we're going to take it more seriously. Now let's go to the daily. So this was the low that we held here. Now your low is back, or you're back above your 21 day for 3 days there. You're going to start getting more serious. Now you're above your 50 day for 3 days, getting more serious. Now you're above your 200 day for 3 days, and you're getting even more serious there. And so let's look at that on a weekly. So, this is where you're getting more serious. And, of course, up here too, and it was over here. Now let's just go out 1 year from there. All right, and that's a monster run, monster run. And then it had to go through a corrective phase. And let's just because I know a lot of people probably haven't studied these. Here it is, 1980. So this was back down over there. Let me unzoom. So this was the level that we were looking at that was holding there. And this is a nice bull market. And of course, you get some pockets of really bad stuff. In fact, let's look there. This did not show up on the thing. Let's go to October 27th, 78. 1978. What did we say? October 27th? Let's see. Yeah. Okay. So, all right. Well, it's somewhat similar. So we've got this run up, kind of going sideways, and then these 2 bad weeks in a row. So down 8.67% and down 6.92. And that didn't even show up in the Grok stuff, nor the Chat GPT. So they suck. That really sucks. But at least this will give us an idea. But some of the dates that did show up in there, let's see. And this is why I always trust Justin's data over anyone else's, because Justin would have had this right. October 7th to 11th in 74. October 7th to 11th. What? 1974. Let's just go back there. This is just on the list. Well, it just doesn't even make any sense. So I'm not going to trust that. But you can see some other bad weeks in there. So this week here, down 4% in June of 74. We had this time in the November of 73, and just go through and play with this. But the difference of everything down here is that it was a prolonged bear market, whereas up here is a bit more relevant, even though the data is so much smaller. But I bet you if you did it in terms of ATR, it would be closer to what we had. All right, so now the next one that they had is 1987, but let's just for fun, let's just go out to the monthly, since we already know that Grok's data is questionable. Let's just go out to 1980, and we're going to look for months where we had bad breaks. So October of 78. So this, that was the one we were just looking at. Okay, and then in 79, you had something similar. So you might want to go back and study that. But I would say that what's different about this one is your 40-week line, which is your, let's blow this up. This 40-week line is like your 200-day, and the devastation there is happened under, above the 200-day or above the 40-week here and here. So it's a little different than today. So let's go back to today to get the weekly fresh in our mind. So the devastation, this is today, current devastation happened up there at first, but then now once your high is stuck underneath the 40-week, these are our bad weeks in there. So down 2.5% then and down 10% there. So let's go back out to 1980. And so more like this, which it didn't show up on their list either. So screw their list. We'll just do this visually because I just hate bad data. So more down in that time frame, and let's go out a month. Let's see. So that's encouraging. So this is the week of March 28th, 1980. So you're kind of in this free fall down here, and it is hard to really make sense of something when it's only closing data. But again, when it came back up here, you really don't want to be getting serious until you get back above your 21-day. But with this devastation, you'd want to, even knowing that it goes higher, most of the time, you're not going to work out like this where it trends up. So you want to be very, very careful. And I would be light until, whatever follow through day in there I would use, but then I would 3 days above your 21-day with your low above your 21-day and closing up, I would take more action. Same thing on the 50-day, and then the same thing with the 200-day. And really, until you get back above that 200-day, you are tempering things. Let's go out couple months. Wow, monster run. So you see how things have really settled down, and the it's tight and it's trading so nicely above that 21-day. I mean, that's why I came up with it. Wow, that is powerful. Really, really powerful. And so let's look at it on a weekly. So again, these bad breaks in here. Let's see what did the S&P look like at that time. Yeah, kind of very, very similar. Let's look at the Dow back in the day. All right, a little bit more mellow. Go back to the NASDAQ. All right, let's go out another year. We'll do it a year at a time. And we're just looking for, because we don't trust their ChatGPT's data, we're looking for bad breaks. So here it's down badly, or it's down bad, almost 6%, but you're well above your 40 weeks, so it doesn't look the same. So let's go out to the end of each year. Just do it a year at a time. So this is more like it. In fact, this is exactly like it, and it's not on this list. It's ridiculous. So 9/4 of 81. So, okay. So this is looking similar, right? So we've got, wow. Got to make a note to myself and study this one this week. 9/4 481. And so this is just how I would be doing my research, frankly. So how does this look the same? It looks very similar. You've been moving up, right? Kind of going sideways here. Then you break down to your 40 week, and then you break below it. And then here we've got 3 bad weeks in a row. So first bad week, 2.5%, then 4.4%, then 4%. So while we have this in our, let's toggle back to, and this is what I'm always doing, is just toggling back to the current day. So this is our current day. So you can see that kind of a similar setup. Prior uptrend goes sideways, break down to your 40 week, and then you have a few bad weeks in a row. And so that other one had 3 bad weeks. So this one was down 2.59 and then 10%. So this one was a lot bigger than back then. But let's go back there. What was it? 9481. 1981. Okay, so let's see what happens the next week. Oh, okay, so that's encouraging. An upside reversal. Let's go out to the end of the month. Ooh, not good. Okay, so an upside reversal, but then it goes lower. Let's go to the daily. So 9.4 was there. Okay, so let's look at that on a daily. So, okay, somewhat similar to what we've got right now. Is you're in this free fall position, and let's just do it. Let's go out a week. Okay, there you're trying to get no follow through day, still a mile away from your 21 day, no clear upside reversals. Doesn't even get a follow through day. You don't get a follow through day. About another week. Okay, it looks like we probably have a follow through day in here. This would be your day 1, and then we don't have the volume on these charts, but that would have qualified for a follow through day if volume was there. So I'd say, at least in spirit, let's go out to the end of the month. Okay, so now at this point, our low is above the 21 day, 1, 2, 3 on this day. Oops, this day. So then you're getting more serious about it, and then your low 1, 2. So on this day with your 50 day, but we're still under a 200 day, so we gotta temper our enthusiasm. It's going up. Oh, running into trouble there. Let's see. How's this going to play out? Not good. Let's go out a couple months. Not good at all. Because you could see here, that's what I was concerned with is you're not getting back above your 200 days, so that when you get close to a moving average and can't get over it, or even if you poke through it and then can't stay above it, then that becomes more of a ceiling. But still, if you would have used your follow through day here, and those other signals here and here that we were talking about, and then waiting for your first break of your 21 day right there on 10.8. So you get a nice trade in there. Let's go out let's go back to the weekly, or we're going to be here all year. Let's just go out to the end of the year. Again, we're looking for bad breaks relatively soon after the 50 day crosses your 200 day, or in this case on a weekly, your 10 crosses your 40. So that's not in position there. I should have just gone to the end of the year. So it'd be more like over here. But the difference here is this has been traveling from its highs for so long that it's not really the same type of precedent. But you do have a bad week in there, down 3.5. Okay, then it got smaller. So those are not good precedents. Okay, still nothing good. More so in here, these weeks. January of 84, January 27th, and February 3rd. So 2 bad weeks in a row. So let's go there to All right, so this is a similar setup. Let's look at it on a daily, uh, where just heavy selling, but not like what we saw this last week, where just things falling apart. But still, it gives you a little bit of a point of reference, and you still go lower. So we're trying to find reality. We're not trying to find something positive. We're not trying to find something negative. We're just sitting and staring at the fish tank and letting it tell us the story. And of course, you guys all remember the fish story, fish tank story from Bill's book. Oops, I went back to today's date. Where were we? 1983? No, we were 84, so we'll go out to 85. Okay, nothing there. Let's go out to the end of the year. December 31st. Okay, so nothing there. Oh, the fish story while we're looking. I think I told this in one of the other ones, and this is from Bill's book. One of my favorite stories in there is Harvard professor. Stop sharing. So this is really the core of everything that I do comes back to this story, really. So it's probably worth telling that, Bill tells the story in there about how this Harvard professor tells his class, hey, write a story on fish. So they all do what Harvard kids do. And they go to the library and write a story. Like, why wouldn't you? That's a logical thing. And then he tears up all the reports that they spent all this time on and said, no, if you want to know about fish, just go look in front of a freaking fish tank. So then they all go and then they do original work, original observation of sitting in front of the fish tank. And that hit home when I read it. It was like, wow, that's just genius level. Like something so simple is like, it doesn't, don't care what someone else has done. Don't care what I've done. Don't care what anyone has done. Like do your own thing. Sit in front of your own fish tank. So as you're sitting here, like if you're yelling at the screen going like, oh, what about this week, Mike? What about this week? Just take notes and go and research it yourself, because maybe I'm just missing it, or maybe I'm seeing it and I just know that this is going to last forever, so I better get through it. Anyways, just the fish story, man. It's all about the fish story and the turkey story and the red dress story. Some of you know what I'm talking about. Okay. So now let's go forward. So this week here, that's kind of interesting. It's kind of similar, 9/12/86. And then for fun, what you could also do to take it to the next level is go and look at what the news is during this time frame. But then that's kind of three-dimensional chess and would take too long. So this is a little bit more of a similar setup, right? You were in this big move up, start breaking down near your 200-day, then you get this kind of free fall situation. But we know that this one firmed up there for a sec. So let's see what happens. We go out a week. Frankly, not what I would have thought, right? That's weird action that it's just, interesting. What's interesting about it is the bars are so tiny versus like these bars in here, the distance from your high to low, which is a big deal for me, are so tiny. Yet these are so bad. And normally after those bad days, you get either a capitulation type of move to the downside, meaning like this bar going down here. Like if all this happened and this bar was down there like that, I'd go, oh, that looks normal and natural, but this just looks weird. Okay, let's see what happens. So it just kind of feels a little wedgy underneath that 20. That is just weird. Like it normally just doesn't drift up through the 21 day as more of an oomph. Let's go out a couple more weeks. Let's go out to the end of the month. All right, so it's just still living underneath that 200 day, so having trouble. Let's go out to the end of the year. All right, so yeah, I guess that was a bit of a warning sign too. It just really wasn't acting normal nor natural, because what you'll see is after a break like this, if you take it like my 50% retracement stuff that I do, and you just think of it from like this level to this level. and just go, okay, let's just say like midpoint is here. Obviously, well, let's just do the math for real. Just breaking out my calculator, 383.89 plus 342.29 divided by 2, 363.09. 363. Oh, yeah, pretty much there. I mean, that's let's do 363. Yeah, so there is my eyeball was, well, it's actually closer to my original one than there. But the reason why I point that out is like and I talk about this a lot on the Friday SMTs, is when you have a clear high and a low, and you can do this on an intraday chart, daily, weekly, monthly chart, and when something breaks or moves up, you do it in both directions. The original direction, in my mind, continues unless you can do a more than 50% retracement and start living in the opposite hemisphere. So we were saying that midpoint was around here. Yeah, it was around here. Between these 2 points, yeah, it looks closer to the low. But anyways, it never lived up here. So that's a sign of weakness. You really need it up here for it to work out. Let's go out another. Okay, so then it finally does that, and you see that 363, that really becomes, kind of a key level there. So, that midpoint. Once it gets above it, boom, it's off to the races. And you get this power here, you get a follow through day in there, and you're back above your 21 day and all. So let's go out. So we know that 87 is on the list, of course. So let's go to the weekly and make sure we haven't missed anything. So we talked about this week. Nothing. Well, so this is probably going to be our closest, right? So we're in a bull market up here, kind of this flat area. We start breaking down. We're underneath the, let's go back a couple weeks. Okay. We're underneath the 200 day and the 40 week now, and we get a bad break down 7%. So all the people who are saying like, oh, it's down so much, it's got to be near the lows, man, dude. Yeah, they could be right. But, so this devastation here, I mean, it looks just brutal, even though that's only down 3.8% relative to everything else. It's just massive bars. Let's do it a day at a time. So there's, wow, down 11% in a day. I mean, we were down 10% for the week. That's in a day. That's the 19th of October, man. That is brutal. There's the 20th. And then you get this inside day up there, up 7%. And this is where you're going to be really tempted to trade. And remember this when you are, because look what ended up happening. Really study this one. And notice you had like follow through day action over here, but then you undercut it by there. So if that was your follow through day, you undercut it there. So now let's go back to the weekly. So these are let's say the 23rd is similar to our current one, but really current one is worse than that. So this bar is a lot worse. It was almost like if that would have closed there, that would have been more like our current bar, or maybe even there. But now let's go just week by week. So an upside reversal week is one thing that we can expect. Then that's tightening up, that's constructive. Tightening up. It's constructive in that position, but still, again, like if you did your 50% retracement from there to there, what is that, like somewhere in that ballpark or so? And so we're nowhere near that. In fact, let's just do the math there. Let's do 453.88, which is here, and then the bottom, 288.49 divided by 2, 371.18, 371. So yeah, right in there is where the midpoint. So we wanted to get back above there before we're even really taking anything seriously. And so let's go out a ways. Still not there. Are we there yet? No. 371. Okay, so right around here, it's starting to get, so let's go on the weekly. So now it's retraced more like, because you can see the price up there, 371.18 was our midpoint. So, and our 10-week line is 364, so it's above that. So let's just go out to the end of that year. Oops, why don't we go out further? So it's just kind of, it's not living in that upper part. It's just kind of in this kind of trading range in there. So there's not, this is really kind of discouraging, right? Because once you need to be able to participate in this move up to your midpoint, but you can't participate in a big way because like the 73, 74, we could have kept going a lot lower. So let's go back into this time frame and see what we can learn. So we're going to go closer to February. Okay. So let's trace back. And this is how I like to do things, to see, okay, what would I have noticed? Like this is too close to the initial damage, and you're also underneath your 21 day. So now you're back above your 21 day over here. And I'm sure we had a follow through day in here, but let's just look at the low 1, 2, 3. So on this day, that's where you're starting to get more serious about the market, because it's 3 days above your low is above your 21 day, and you close up. And then let's see the 50 day, 1, 2, 3. So on this day is when you would have started getting more serious because of the 50 day. And then of course, the fact that your 50 day then finally turns positive there, it's more meaningful. So this is how you would have been able to participate in there. And let's see how long it stays above that 21 day. So yeah, so again, you're starting to get more serious over here, and you're above your 21 day until over here. So, just using the strategy I like to use that I've developed that would allow you to trade there. But frankly, even if this would have ripped straight up to new highs during this time frame underneath your 200 day, I would still be taking it mellow, because you could have had another collapse down there. So this is our first real kind of precedent. And so what does that tell us? That one, ours isn't as bad as this yet. And hopefully it doesn't get there, but you never know. Keep an open mind. So we're more like in this ballpark just by eye, just visually, just guesstimating that. So we could have a lot further to go. Now it is a different, environment and everything now than it was back then. But there's still fear, greed, and hope last time I checked. All right, so wow, we're never going to get done if I go at this pace, Mike. Come on, man. I told myself it was going to be a short one. And I believed myself. So let's see. Okay, we don't have it. Now we're looking for a new example. We don't have any major breaks. So let's go out. That's 1989. Let's go out to 90. Okay, now visually you can see that it looks like it's over here. So 83 of 90. And well, that one didn't make my list. Let me see if it made the chat GPT. It didn't make the chat GPT. Yeah, AI still sucks. All right, so we're going to go to 8390. Okay, so this is a little bit more like our current setup, but what's different is this is more like basing here. You do get a little bit of flat base and you do get a little bit of a prior uptrend, but compared to our current market, and let's just go back to this 8390. Let's go back to today and look how different that is because it had been trending above the 200-day forever and then you break. So it's really different type of environment, but still a bad break there. Um, Down almost 3% and down over 5.5%. So let's see what happens the following week. We go lower, lower, a lot lower. So let's look at this on a daily. So anyone who's thinking, and this is kind of like what had happened, it just kind of poked up for a little bit, but never really powerful, no follow through day, and more importantly, not above your 21 day. And then once you took that out, man, that's ugly. And okay, it's trying to stabilize. Let's go out a month. Wow. And just pay attention to that 21 day. It's still not above it. Upside reversal, that's encouraging. But boy, that can't even, look at that. That can't even hold in. It can't get back above the 21 day. Look at it, it's a ceiling again. That's stressful. I'm not even kidding. Like when I do this, I put myself in the shoes of being there. Like I do this so often that I really have to mentally get in there. Like I'm trapped in the market and I've forgotten the rules and I somehow I'm still in because even though I was out this week, like what if, what if for some reason I had some stocks that I really liked or something that, that because I was looking at BABA, and I was trading BABA a little bit and it looked like it was hanging in there and I was thinking of rotating into, because I tried it a few times and it wasn't making any forward progress, but not getting hurt badly, but just not making much progress, up or down. But then it was coming into the 21 day and I'm like, okay, well, maybe I'll trade it. But I'm like, you know what if China retaliates? Sure enough, they did, and so, but what if I had made that exception? Because I almost did and I almost bought it, man. Well, let's just go there. Let's see. So we're in November of 90. Let's see. So this is what I was looking at. And I think it was totally legitimate here. I probably tried it there. I'm sure I did back above the 20. And I think I tried it a few times in there in K-Web as well. But on this day, I almost bought it. Let's see, on the 3rd. Because it was getting support right before the 50 day. And it was holding up so much better than the market. Like, let's look at the current market, here in the US, or like Google, its US competitor in a lot of ways. And that was falling apart. And that's like a lot of positive divergence. And frankly, if China hadn't done what they did, this could have been a 140 on Friday, really, but the risk reward to me just wasn't there. And but I was right on the fence. I think I probably traded it for like intraday a little bit, but then backed away and just said, I do that a lot of times. I'll put on the trade and then I'll go, what was I doing? And I'll just back out of it, because then that news came, but it did get support there. But still, I mean, down 10%, I would have been slaughtered, and that was after it bounced off the lows. So even the best names, and I tweeted this out that, oh shoot, I thought I was sharing. Gosh darn it. I don't know how long I wasn't sharing. I'm sorry, guys. I feel really bad. If I had a crew or something, let's go back to what I was looking at. Wow, we're in like November of 90, maybe. Let me see. Okay, so what I was showing with BABA, while I have it up here, is that, with BABA on this day there, on the 3rd, that I almost would have held that overnight, but high was still underneath the 21 day. And even though that RS line looked great, it was just this overhang of waiting to see if China was going to retaliate with tariffs or not, and then what the reaction was going to be. And if there was if they would have just done something very small, then there would have been a relief rally, and that could have been up to 140. But that's just a risk event, it was just a gamble. So I'm glad I didn't take it, or I could have gotten my head handed to me. So I was just talking about how, like, even though I was out this week in the market, I don't remember what date we were at. 19, we're at 90, I think. Oh yeah, we're at 90. That we were talking about it, like, over here, I think that, these little rallies that you would have maybe wanted to do something with, but you didn't even have a follow through day, and you're stuck underneath that 21 day. So again, sorry that I wasn't sharing that the whole time. So now we finally get above our 21 day, lows above it for 3 days right there. Come back and test it. Don't close below it. So that's encouraging. It's going in the right direction. We'll go out to the end of the year. So our low is above our 50 day, 1, 2, 3 on this day, but really feels like it's more like over here, because that's when it kind of flattens out. But still, either one, or you could do it incrementally. And that 21 days, above that 50. So, we were talking like over here, right? 1, 2, 3, like over here. And now we have some positive movement. Let's see how this plays out. We go out a month. So this would have been tricky in here, but then you're off to the races. And this ends up being a really powerful move. I remember that one. Let's see. Really, really powerful. So let's look at this weekly. We're coming down here. The news is horrible. And just remember that this is a possible outcome, this 1990 time frame, because we could be here, which would mean we would have a lot further to go. But when things turned, and then especially when they got back above the 200-day or the 40-week line, it was completely different. And then you're off to the races. So that will be in the cards. Again, these things do resolve, so don't get too discouraged, but you also want to look at reality. And we're trying to find something. We're trying to find reality. We're not trying to find something to make us feel good or feel bad. We just want reality. And so far, it's not looking too good. Okay, so now let's go out to the end of this year. Let's try to find another one. And I would really go back and study this time frame. So again, this was 1990. The beginning of 1991, and I would go through all that news. I don't want to get into it, but you'll find it interesting. Let's go out to 92. No real bad weeks in there. Go out to 93. No real compelling things there. 94. You got a bad week there, but no, the rest of the setup isn't really the same. This one is it's been living under there, and then it goes down, so that's not the same either. Let's go out to 95. Nothing there. 96. Okay. Here we've got some. This is kind of interesting. Oh, you know what? But the damage is still above the 200-day, and then over here it's getting support. So you can see these weeks in. When it breaks down, they're getting support. So that's a lot different than what we saw. So by the end of the Friday, you're closing back near your highs on both of those weeks. So it's just not a good precedent. 97. Okay, so again, the 40-week line, which is this black line, is similar to your 200-day. So we're looking for times where the bad breaks are underneath there. So that's not what happens there. And then, of course, 98, this is kind of a classic one. We've talked about this a lot. So you could argue that we are kind of like here maybe because we closed at the lows. So an 8.79 decline on August 28th. So let's look there. So somewhat like it, you were in a bull market. Doesn't really have a flat base near the top, and then you come down from the top down to here, So it's kind of the bad break that we had. And now you get some devastation under the 200-day or the 40-week line. So let's go back to the daily. So this feels a bit more like our free fall that we had. Let's go out a week. So we're starting to get an upside reversal. So this is something that we can expect. That would be normal, like a shakeout, upside reversal. And let's go out another week. So then you get, it's starting to firm up, but notice how it's all over the place. So how are you going to trade that? Let's say you bought some on the upside reversal. Could totally, I would see doing that. And then your low that day is your line in the sand. So now it's bounced up from here to here. So let's just go to the second. My parents' anniversary, the perfect couple. And let's see. So the midpoint would be somewhere in here. So you're wanting it to kind of stay above that 50% retracement. And that is what ends up happening. So that's constructive. We'll go out to that week. So it's constructive, but it's all over the place. So you can't trade it in any big way because look, you get a gap up that you're chasing, then you get a downside reversal that you might be shorting, then it gaps down, then you get this. So this is a reminder that after devastation, kind of like 87, you don't want to play heavy because you need things to settle down. So it's starting to settle down there. Went out a week. Let's go out another week. It's moving back up. So we've got our third day up with our low above the 21 day. And where was our follow through day? So that was probably enough for a follow through day there. If not, certainly that day on the 23rd. Let's see. These days, the volume wasn't like this would be a follow through day. Oh, 1, 2, 3. Oh, yeah. There's your follow through day right there. September 8th. But then you close below it. So it would negate that. So if you bought there, you would be selling there because you don't know that this is going to happen. Then you get into, no, that's not a follow through. On this day, you get an additional follow through day and your low is back above your 21 day. So you're buying there and then you're adding to it on this day because your low has been above your 21 day for 3 days. But you do have in the back of your mind that you're just right at this 50 day coming through the 200 day and you're stuck underneath it. So you're going to have to be careful. But I'm still going to be in there. And I know what happens, but I'm still going to be in there. So let's go out a few days. But right away, now you close back below your 21 day. You found resistance at your 50 days. So you're freaking out of Dodge and out of Doge. Okay. So I'm sorry, I'm not going to start that can of worms. Boy, I get hate. Okay. So now you get an upside reversal here. So the thought is you want to hold above that one, but there's no compelling reason to buy this point because you're in a sloppy place, but at least you're encouraged there. From a swing trade, you could trade there and with hopes that it moves up. But that was short-lived. That was there. And so by the next morning, you'd have to be out. And frankly, I would have bought some. Not a lot. I would have bought some. So you're wanting to put yourself there. Like, so 10-2, just say, okay, would you buy there? Yes or no? But hold yourself to that because if you have a setup like this and then it ends up working, don't you dare tell me that you would have bought there. So you want to be, you have to have legitimate reasons. For me, upside reversal, shake out, it looks like it wants to go back up to at least test the 21 day. So this is not a position trade. This would be like a swing trade and it would be small, but I'd want to get a little something there. Now, if you say, no, I'm not going to trade because you're underneath the 21 day, totally fine with it. I'm not going to trade because you're underneath the 50 day, fine. I'm not going to trade because it's underneath the 200 day, fine. 50 is under the 200 day, you don't want to trade, that's fine. Your follow through day has already failed, you're waiting for a new follow through day, that's fine. All those are legitimate, or any other reason that you have. Maybe you're saying that, from here to here, maybe we're still in the lower half. It looks like it's probably thereabouts, that you're going to want to wait for it to start trading up there. Totally legitimate, but have a reason. And I know myself, I'd be buying some there, and then back out of it. On this day, that's a gap down upside reversal. I'm not going to be buying that because that's just not compelling enough for me And now the next day I'm going to be having FOMO, just going, oh shoot, man, I probably missed my opportunity. So, and I tried it here, but why wouldn't I try it? Why wouldn't I try it there? But, just knowing myself, you're still down 3% on the day. Yeah, you close up on the day, but if this was a normal bar from here to here, that's not that compelling, right? But it's certainly your day one of a rally attempt. So that's your day one. Now you're on day two. So let's go out. Day three, day four, you're waiting for your follow through day. Okay. So here you get it. So now you're up 2.09%. And your volume's higher than your prior day. So now you get a follow through day. So now you're acting on it, and you should act because that's the rule. October 14th. So you're buying, and I'm going to wait for to get above the 21 day to get serious. Oh, that happened fast. So now close back above your 21 day, up 4.5%. Like now you've got a double bottom. You got something to trade with, right? So now you're saying if we can get through there, we should be off to the races. That becomes the magnet. And if you're short, you're really getting concerned that you're going to get squeezed. So that's kind of probably a lot of this buying was the shorting. I remember trading through this. Okay, so you're low 1, 2, 3. Okay, so on this day, I'm starting to get really serious about it because your low is above your 21 day for 3 days. You close up on the day, and you're back above your 50 day. So now your low is above your 1, 2, 3. 1, 2. So on this day, your low is above your 50 day for 3 days. Close up on it. I'm getting even more serious. 21 days going through there. And you're off to the races. Now you're back above the 21 or the 200 day. Wow, that was a fun rally. Okay, so what did we learn from this one? Let's go back to the weekly. That we were saying that we might be over here. So again, that's August, and you're really not okay until October. So again, kind of the time element, same thing with like 1987. So let's go out and try to find another one in here. Nothing there. Okay. So these breaks over here, not really the same. Let's go over here to 4/14/2000. And the reason, 4/14. So even though you had, down 25% that week, God, wow, that was terrible times. That it's not really in the same position because the week before you had kind of an upside revert. Let's go to the week before. You're well off the lows, like it's a different position than where we are now. And then here, this bad break, but you are below your 200 day. But so it does become something possible, but the magnitude is so much worse than what we have now that it's not really a true comparison. And then you firm up there a little bit. So not really a good example. So let's see. I'm going to turn that off so that doesn't happen again. I don't know. Okay. I'm just trying to see if there's anything else in here. Like that week is bad, down 4%, but it's not really the same position. So we'll go out another month. Nothing there. Nothing there. So we're going to just focusing in over here because we're back underneath the 40-week line. So 2 back-to-back weeks there, but still not the same because they weren't underneath the 200. So let's go back to our current October 31st of 2000. Let's go back to our current one. Again, we had a few weeks down to our 40-week line, kind of went flat, and then had 2 bad weeks. 1 week down 2.59, the next one down 10%. So acceleration on the second week down and both closing at the low. So that's what we're looking for. And what were we? 10, 30, 2000, something like that, right? In that ballpark. So not really, I don't know how to turn those off. Kind of like this, but not really at all. So 10, 6 of 20. So the 10, 6. So let's look at it on a daily. So kind of like this, but really there's not those really bad breaks. So we're not going to really use that as a precedent. So this is just how this work goes. Let's go out to the end of the year. And you can see some bad times in there, but not really the same setup that we currently have. Let's go out a few months. Nothing really, because this is now we're deep into the bear market. So even though some of these might fit, the same percentages or closing ranges and stuff, you're already deep into the bear, and so the psychology is a lot different. But it does kind of feel a little bit like this, where you get 2 weeks in a row closing near your lows, and then so that was in March of 2001. Then you get a little upside reversal, but you still go lower. But still, really, just go out a ways. Do you see anything that looks like it? I'm not really seeing anything. So you get a couple weeks here, this week and this week, that look bad, and then you end up going a lot lower. But in fairness, we've been in this bear market forever. Go out another quarter. Okay, so nothing really looking the same. There are a couple bad weeks in a row there, closing near the lows, and then you stabilize a little bit. But again, we'll just go out to the end of this year, 02. Okay, so nothing there. We'll go out to the end of 03. And that was a bad bear market. So nothing there. 04. Okay, so a little bit more like over here. So 723. Let me blow this up a little bit. Okay. 723. Okay, so somewhat like this, where we're relatively, we've had a bull market. We're kind of fresh near our break of our 40-week line, and you've got 2 bad weeks down 3.25. And this one is only down a little bit, but they're both closing near the lows. Let's see what it looks like on a daily basis. So I'll unzoom that a little bit. Okay, so let's see what ends up happening the following week. Firms up a little bit. We'll go out to another month. So we were over here. So it continues lower. So let's go back to the weekly. Not really a good precedent. So we got 2 bad weeks in a row there, another 2 bad weeks. But again, that was a little bit further in on this. Go out to the end of the year. Nothing there. So let's go out 1 year, go out to 05. Kind of like that, but not really. So we're going to go to 06. Okay, so it kind of looks like this, right? To 721 of 06. Okay, so not exactly the same thing, but you got a bad break there, down 4.3. Only down a little bit, so we're not going to do that one. But let's just see what it does the next week. So firms up a bit. Let's go out 2 more weeks and stays underneath there. Let's go to the daily. Yeah, doesn't really feel like it. Okay, so go out to 07. 2 bad weeks, but it's still above the 40. Go out to the end of the year. Okay, so now we're more in the position where the 10 week is starting to cross through the 40. So let's go out just a month. Okay, so it's feeling a little bit more like this week here, January 18th. All right, so this is a bit more of the setup where, we were in a bull market, kind of goes sideways near new highs, and we break down, and now we're breaking badly Breaking Bad. That's a good TV show. Show me what did he say? Where's my money or something like that. I think I have a mug that says "Where's my money?" In the garage somewhere. Okay, so it kind of closes near the lows. Highs underneath the 40 week, breaks badly. So this is a pretty similar setup. So let's look at the daily. We've got some gaps in here, some devastation, some bad days in there, 3.7 on a day. So let's go out a week. So eventually we come down, we have kind of an upside reversal day here. And you're up for a couple days. So yeah, you could have considered buying some there, kind of an outside day in spirit, not really an outside day, upside reversal if you're dying to try some there, but really shouldn't. And then we're right back with another downside reversal. So you come across here, that's actually a follow through day. And so you got to take some action there. We know that this keeps going lower, but you've got to put yourself back in that position. So now this is more normal. Follow through day. Let's go out couple of weeks. And then, so where was our follow through day? Here. And the low of the follow through there was there. So you buy there, you sell there. You sell 2.5. There. That's the system. Buy, sell. Simple as that, because you close back below the low of your follow through day and you never got above your 21 day. So let's go out to the end of the month. And that's why you only do that. But you do that trade because there was a rule around it, Let's go out a couple months. So even during the 2008, that was a tradable rally. So you could go study that, but that's not what we're studying today. So kind of looks like it here, but again, we're in a different position because then you've been in an established downtrend. So the psychology of the market is different. We're still closer near the top. So people are still have heavy positions. Whereas by then, a lot of the smart money would have gotten light. Okay, so this feels a bit more like it because of the dramatic selling that we've had. So let's go to 10-10-08. So this probably feels the closest to it because on the weekly chart, it looks really bad. Now, what's different there is it started stabilizing by Friday because you're well off your lows, but still it's down 15% for the week. So again, different position because you're so far versus your old highs and where we are currently, but that is a bad break. Let's look at it on a daily. So really kind of looks more like there. Like if we close there, if this was our Friday, that looks more like what we've got. Like, oh boy, the world is coming to an end. So 10-10, upside reversal. And this is more like a climactic type of action closing, near your low. So if you're going to buy that from a very tactical, very aggressive, looking for a mean reversion trade, you could do that with that as your low. With your risk is that you risk a gap down. But this is not part of the system. I'm just saying that, I could probably see myself doing that. And then this day, I'd be like, wow, that was a lot more powerful than I thought. But why you would buy on the upside reversal is because you don't want to buy on this day that's up, 11%, because then you're chasing and then your line in the sand is really your low of over here. So how are you going to live through that? Whereas with this, maybe you could have survived this because it never undercut that. But man, that would have been difficult because just being honest, I would have bought here with this type of action. I would have added to it. And then with the downside reversal, I might have just blown out the whole thing, just turning and running scared. So I don't think I would have been able to even survive through that. Because once you're up off your lows with the upside reversal, you don't want to give all that back. Like once you're up here, that's 11% from, and you're well off your lows here. So you don't want to be saying, I'm going to give all of that back. So I, most likely would have been out on, so let's just go back through that. And I'm just knowing myself, and if I was trading right now, if I was trading with hope, fear, um, ignorance or greed, then I would have, who knows what would have been happening. But if I was, when you do this, you want to pretend like you're doing it right in your style. And if you're going to say you're not going to play at all, there's nothing wrong with that. I'm just telling you from an active standpoint what I've done. Okay, so now let's go out. Let's see. Let's just go out to the end of the week. Okay, just goes out lower. So even if you had survived this by this time, you got to be back out. And that's why I'm saying, like, really, that with that downside reversal would have been out. Okay, so I can't do day by day for freaking 20 years. So let me jump forward. Let's go forward to the end of the year. No other times that really look like that. So again, if you want to go back and study that, that was October 10th of 08. Our closest real precedent besides 87. So nothing really looking like it. Now we go out to the market bottom. Let's see, was there anything in here? I mean, maybe you could say these 2 weeks, let's say go to the 27th, where, closing near your lows, down 4%, and then the week before it down 6%. So a little different because we've accelerated our selling this week in the current market, whereas this one kind of slowed down. But let's go out. So then you go lower, so down another 6%, and then eventually you hit bottom. And then you get your follow through day, and then you're off to the races. So let's see. Let's go out to the end of that year. Okay, we'll try to find another one. To 10. Okay, so it kind of looks, no, not really. That was only one bad week in there. Okay, so that's not really like it. Go out to 11. So it kind of feels like this, but that's only 1 week. And then this week you close back up. So not really. No, not really. Even though that action is worth studying a lot in that 2011 because it feels a lot like that, but our setup isn't the same now. This setup would be more similar, but again, we've been going down for a while. So let's go back there. 11, 25, 11. 11, 25, 2011. So a bit more like it because down 4%, down 5%, closing near your lows, underneath your 10-week line. But again, we are near some support action here versus let's go back. I got a 11, 25, 11. Let's go back to our current one. You're always wanting to toggle back and forth. So what I like to do is I'll keep the current chart. I'll either print it off or I'll have it over on another monitor so I can always reference it. But since we're doing it from a single monitor view. So you can see how different this is because this is like look out below. There's no support around here versus what were we? That wasn't it, but it was around. Okay. Yeah, it's here. So, this support makes this look a bit differently because there's a floor there. Let's go out a week. Oh, my sister's birthday. So right away you firmed up. So we were down there and you can't really do anything on that gap up. Now, the first thing you can do is something here because you're back above your 21 day. Let's go out to the end of the month. So you're back above your 21 day, and that is only day 3. Yeah, so your follow through day. No, I'm not seeing one there. Probably over here. Yeah, that would have been your follow through day in a weird position, but you were above your 21 day and then you close back below it. So if you got in here, you'd be back out there. Plus you got resistance at your 200 day. So again, a bit different because this being here does not, we don't have any near-term support, which is the problem, right? Let's go out of the ways. Let's go to the weekly. Let's go on to the end of the year. So in some ways it's similar, but in other ways it's not. Not when you're looking at it from a weekly standpoint. On a daily, you might find some precedents in there. Okay, so nothing there. Nothing there. We're just going out 1 year at a time. 2014. Nothing there. Let's see. Nothing there. 2016. Okay. Actually, right there, that looks in the ballpark. Let's see. January 15th, 2016. Okay. So you do have this support area here, but it is, somewhat similar. You've got down 7% and down 3%. So again, different in that right now our selling is accelerating versus this was decelerating. So a little bit of a difference. So, when the numbers are getting bigger, just got to jot this down, January 15th, 16. So let's go back to our current one to see. So again, your position is different because you have this support week there, but two really free falls here, down 7% and then down 3% versus our current one, we're down 2.5% and then 10%. So, roughly almost four times what we were down the prior week. So that's different in that the selling is accelerating. You want it to decelerate. So let's see, 1/15/2016. Okay, but let's see what happens about a week. So here we get an upside reversal. So there was our, that was the Friday. And you have a couple days down, and then you have this shakeout there. I could easily see something like that happen. Let's go out a week. So you get your follow through day there, right there. So that legit follow through day, closing at your highs. Definitely take action there. Let's see, go out a week. Okay, so that was your follow through day. Definitely taking action there, and you close. You traded underneath. It doesn't look like it closed underneath it until there. So on this day, on the 3rd, that was the day that you would have thrown in the towel from this one. You would have been backing away here, but certainly throwing in the towel there because you closed back underneath it and you couldn't get back above your 21 day, the green line. Now you get back above it, but let's go out to that. I got to be careful because I'm going to be here all year. Okay, let's go out to the 17. So we look there. Let's go out to 18. Nothing there. Let's go out to 19. Okay, so we've talked about this one a lot, and this is, it's somewhat similar to this December 21st one, because we had this week here only down 0.84, but still closing near your lows, 2 weeks in a row. So you can kind of combine the two, this week and this week with the week before last, and then this week down 8%. So this looks somewhat similar. Let's look at it on a daily basis and let's walk through this. So not exactly the same, and we had been using this as the precedent, but we're kind of throwing it out because it looks so different now. But we've accelerated through here because in time we're more like in this area, but in percentage we're closer to over here. So let's go. This is new Christmas Eve. Okay, so now we get our first up day on the day after Christmas, up 5%, but you really can't take action because it's not an upside reversal. It's just an up day and a downtrend. Yes, we know it doesn't go lower, I don't think, but you can't really, I don't know how to buy there because if I bought there, then I would have bought a million other places. So that's a hard day and it's stalling out. This was the day that really changed it on the 4th. So this is really your follow through day in spirit. You get back to your the volume wasn't higher than the prior day, but you get back to your 21 day, and this is where Powell um, does the talk, and it kind of changed the tone of the market. So that's what we're waiting for, really. If this is our precedent um, or potential precedent, that we're still waiting for a follow through day, and let's look and see how this played out. You get your follow through day, 1, 2, 3, low above your 21 day for 3 days right there, hitting on the gas. Then low above your 50 day for 3 days, hitting on the gas more. It does come in a bit. Let's go out another month. So this is where you were hitting on the gas. Now your 21 day is, back above your 50, and your low is above there. So you're getting into power trend. I need to go over the power trend. That's something I developed with Chuck and Justin, and probably the most important thing I did in a group setting. Let's see. It was part of market school. Let's go out a week. Let's go out to the end of the month. So we had this one little shakeout around the 200 day, which happens a lot. Frankly, that makes it really hard. But then once you're back above it, low above it, 3 days, and closing back up. So certainly tricky for these weeks. So you should really study that. Anytime you get around a 200 day, you kind of want to back off, because this is normal and natural. And you want to see how the market handles itself. Now, sometimes you just go through it like it's butter and it just keeps going up, but those are few and far between. Let's go out a month. And so it just keeps going. Okay, let's go back to the weekly, because we cannot go, what year are we? Day by day through the entire history of the market. Okay, got a data problem there. Okay, so it kind of doesn't really feel like in here, because this week you closed mid-range, and then this week, let's just go down there. Let's just pretend that it's that low, because anything can happen. You want to be open for it. So let's just say it's that we're in this free fall. It feels like we're not down that far yet, but how do you trade this? You got to be heavily in cash or totally in cash, because you can't even go short, because you're up a bunch one day, down a bunch the next day. Like, how do you trade this? Down 9%, up 9%, then down 12%, up 6%. So this is a stay away market, and that's why you want things to settle down. Let's go out to the end of the month. And I think on the 6th was our Tom Petty follow through day. Yeah, won't back down follow through day. So this was how it changed, and you're back above your 21 days. So if we are in this, again, you're waiting for your 21 day, and you're in a follow through day. Let's go out to the end of the month, and then this powers through again, pokes through the 200 day, comes back down one last shakeout, and then your low is above it. Let's see, 1, 2, 3. So there, third day where your low is above your 200 day. And over here, let's see, 1, 2, 3. So on that, your third day. So you get your follow through day above your 21 day, adding exposure, 3 days above it, adding more exposure, and then adding more exposure there. I remember during this time, I thought it was going to be like 1998 and come back down. I was wrong. But this was unprecedented, let's see. Now it's trending up. So let's go back to our weekly. Wow. Man, I can ramble. It's it's been a long week. I'm running on fumes, so sorry if I'm a little less energetic than normal, because man, I'm running on fumes. Okay, 2022. So let's see, where do we find something in here? Yeah, right there, 7. Well, not exactly right, because 7. Let's look. Go back there, January 21st. So what looks similar is you this bad week closing near your lows, and you're underneath your 10-week line, and or your 40-week, and you don't have any near-term area of support. So that's certainly in the cards. But the prior week wasn't exactly the same, but it's close. So then let's see what happens the following week. So you get an upside reversal. Let's look to the daily. So you come back down. Okay, so this is your Monday on the 24th. So that's a potential. Like I can really see like that would feel normal and natural, like a clean out, like gap down on Monday, and then bottom fishers come in, and then you get a big rally like that. I could see that, and then most people should not do anything. I'll probably put on a trade and use this as the low, and probably regret it later because it's so far away from there, and you can't be buying it down here. Because if you're buying it down there, then you're buying it here as well, and you're buying it here as well, and you're buying it here and here. And I see all these people like try to pick bottoms, but yeah, they show the bottom that worked, but what about all the other ones? So, but no, you really shouldn't do anything. And then inside day, that's down 2.28%. So if you're going to play, you got to play really small. And then look at that, that's terrible action, and that's horrible action. So if I would have bought anything there, certainly by this day I would have been reducing substantially, would have been out there, because I don't care if this works out. It's too volatile. Then you get this, just this is why you want to wait for a fall through. I'm talking to myself like, Mike, don't do it. Frankie Goes to Hollywood. Okay, so no one got that. Well, one person got that. And I will not confirm nor deny if I used to have a Frankie Goes Hollywood t-shirt. Let's see, in like neon or something, man. Well, you're like 13 once. Okay, let's see. 31st, let's go there. January 31st. Okay, legit. Follow through day. Definitely buying. Absolutely buying. I don't care what happens, I'm buying. And then next day, normal action, and abnormal action. Okay, so you get back above your 21 day and you go back below it. So even though we're not back below the low of your follow through day, I'm exiting. So I'm buying on this day, adding to it on this day because you close back above your 21 day, probably adding to it here because of good action, and then got to get out of it. You're down 3.74% and you're closing well below your 21 day. And frankly, even though you're not back below the low of your follow through day, I'm out of there. And then it firms up just to mess with you. Let's go out a week. And then you get one more move back above it. So you can just see how dangerous it is. And the overriding thing that as I look at these charts and I'm telling myself is, when you're underneath the 200 day, bad things tend to happen. When your 21 day is underneath your 200 day, really bad things tend to happen. So just be careful, because yeah, totally would have bought that and then would have been selling there. So let's go out a month to the end of the month, and then it goes down lower. You get an upside reversal, kind of like as my good friend Scott Sinclair would say, rinse and repeat. You give it a shot, and it would have worked for a little bit, but found resistance at the 21 day. So that would have been concerning, and certainly by there you're like, I'm out of here. Now you get back above your 21 day there, and some additional follow through days in here. So you're getting exposure back, and your low is above your 21 day, 1, 2, 3. So like in here, you're adding more to it. But again, you're underneath your 200 days. So you're really wanting to take it easy. Let's go out a month. And then it fails at the 200 days. So let's go back to the weekly and find some other weeks where it looks like it. So you could say that these 2 weeks kind of look like it. But then again, we've been going in this bear market for a bit. But let's just say that that's a possible precedent. Let's go out another week. And you can see this chop and slop. Don't get follow through days. You stay underneath your 21 day. Just think about it. If you just wait for your 21 day, you don't even use follow through days, you don't use upside reversals, you just use your 21 day. And let's just say when you're underneath the 200 day, you're really, really being careful, and you're saying, I'm going to be really late, but I'm going to use the low above your 21 day for 3 days in a row, closing up before you do anything in any material way. So 1, 2, 3, 1, 2, 3. So this day. And then you're exiting when you close back below your 21 day. So there. So from here, this whole time, that would have just been your only trade in there. Just that little bit. using that strategy. So think about it, test it out, see if that meshes with your personality. I'm too active to implement that all the time, but the more I do this, the more I'm thinking I should just, do that. Well, let's go out a bit. And look, your low never gets above it. It's certainly not for 3 days. Look at that. Just it keeps you out of that mess. And then over here, looks like it, I think it happened there. Let's go out a month. Let's see. No, it doesn't happen there. 1, 2, 3. So there. But then it closes back below it. So buy, sell. 1, 2, 3. Buy again, sell. So is it perfect? No, but during this whole time, if you would have been implementing that, certainly let's just say once you're underneath the 200-day implementing that rule, you would have been in for a few days here and a few days here, and then for this. You know what? Compared to what I actually did, I wish I would have done this. Okay, so let's go back out to the weekly. My problem is I like to play too much. Let's go end of 23. So kind of like this one, but not really. Like the October of 23. And let's just reset to today. So that was here that we were talking about. And then nothing else other than here. Stop sharing. Wow, I'm tired. Oh man, I had so much else I was going to go over. Oh, screw it. Let's do it. Let's do this. Let's not be a wimp, Mike. I was going to go through a bunch of other stuff, but I'm going to just do some of it because this is important. And we don't have 1987 or we don't have 1929 in the database. In market search, so I'm going to use TradeStation for that. So let me share that because I just did want to show this. This is 1929. And let me make sure I'm sharing this. Yeah, okay. This is 1929. I'm using TradeStation. Let's just blow this up a little bit more so you can see it. All right. So, and this is a daily chart of the Dow. So we're moving up. We've got a nice, nice bull. It's moving up nicely. And this is our 21-day, our 50-day, and our 200-day. So 21 in blue. Going along, all is good. If you've never studied the crash of 87 as well as 1929, it's just so fascinating. It's like 1999 and 2000. I was obsessed with it, and then I was obsessed again in 2002, 2003. I'll do something on that. Learned so much from that. So here we're breaking off the highs, get a follow through day in here on this day. I believe it's on October 10th of 1929. Let's go there. Let's blow this up. Okay, so as a point of reference right here is August 30th of 1929. Hopefully this doesn't mess things up. I'm going to go to a weekly. Is that going to mess it up? Let's see. So that's just, yeah, that messed it up. Darn it. TradeStation can be temperamental. Now we're at 1980. I shouldn't have done that. Let's see. Okay. This is going to be a pain. Let's just do it the old-fashioned way. Sorry, guys. Where is that? That's 1929, January. Okay. So let's see, where are we? Okay, so now we break through our 50-day over here. come down, hit our 200 day. On this day, we get a follow through day here. So on October 29th. So I just hate when people, anybody, I'm just sorry, but point out how there was enough distribution to get you out over there. Yes, that's true. But you also had a follow through day here. So it's not that distribution doesn't work, it's that you've got to put the system together, and you can't cherry pick and say, oh, yeah, distribution got you out in 1929. No, follow through day undercut got you out in 1929 because this got you out over here. Then you, on October 10th, you get your follow through day here. And then when you undercut it here on October 16th of 29, that the system gets you out. And also look how it couldn't hold the 21 day, and you never got your 3 days back above it. So then you move forward and look at these days, like, bad day here underneath your 200 day, goes down lower. You think all is good. Let me blow this up even more. So there's the 1010 and some bad days, October, another really bad day, another really bad day, another really bad day, another really bad day. And look at this, but you're underneath your 200 day. And why I'm saying that you wait for a follow through day, but really wait for your low to get back above your 21 day for 3 days or more. And then use your 21 day as a floor. So here, low, but it looks like it closes lower, so you don't get it there. But if you did, let's just say you did get it on one of these, then you'd be back out on here. So no harm, no foul. And you're underneath your 200 day. Let me unzoom it. Oops. Have a little bit more of a, when you do this, you can see the crash a little bit better through this. Look how bad that is. Oh, I hate this. Okay, that's about right. So this looks so much like 1987, right? You get this bad break, then things start to tighten up a little bit, and you're starting to trend back above your 21 day over here. So you could certainly trade that until over here, trade this until over there, and then you're back out. And look at how bad this gets. I mean, it was a totally different time with totally different problems and not the same safety nets that we have here. So, but it was very similar to what happened in 2000 to 2002. So little bits of time from here to here, August of 1930 up to over here, where you could have traded just using that 21 day, but using the 21 day, that system that I explained, while you're underneath your 200 day, it would still allow you to play these little pockets of windows here, but then you stay out of all this mess. And then a little pocket of window here, and then you're back out of all this mess. A little pocket here, you're out. So hopefully this is helpful. And then in 1932, when we finally hit bottom, this is just like October of 2002. And, I believe I was the first one to recognize that whole 1932 to or 2002 being like 1932, 2000 being like 1999, and then that whole thing, and I have a whole story on that, and that was pretty big discovery. Afterwards, everyone talks about it. It's so obvious, but didn't hear a damn soul talking about it when I was. I'll do a whole one on that. That's worthwhile. So then this is like October 2002, and then this is just like March of 2003. But anyways, I just wanted to share that with you, and then let's go back to a weekly. on this and see if now that's 1987. Let's go through time, see if we find other times that, oh, it was giving me problems on weekly going back to the 20s, but let's go to 1987 over here. And you can see how devastating that was, but really about how it, you closed well off your lows that 1 week. So that's dramatically different than what we currently have. So I'm going to stop sharing. So I did want to share that. I also wanted to just kind of, because right now, and I know we've already been going 2 hours, but I think this is important to go over my take on, and I'll just do a brief overview and might circle back to it in future ones on why I don't use secondary indicators. There are a lot of people out there use secondary indicators, meaning typically like psychological indicators, like a bull bear, or I think it's a CNN fear greed index, and then there's that I wrote it down because everyone uses it. Don't use it at all, but NAAIM one. I think all these are silly and problematic. The bond market, all sorts of other things, and I'm going to explain why. Don't say Mike's off the reservation. I'm going to explain why, and I think this story might do a good job explaining it. Let me just close a few things and then bring up. Okay, so I'm going to bring up the share. Okay, so on our website, no waiting install. I don't want that. Okay, this is our put to call ratio, and what this is a measure of options, just the ratio, and the concept is that when there's excessive fear, lots of people are going to be buying puts, a lot more puts than calls. So when that spikes up to like a 1.15, as that red line is right there, that's in theory that people are panicking, and there's all this fear out there, and there's all the different measurements. People like to use the VIX, people like to use put to call, like to use bull bear, they like to use the other ones that I mentioned, and a whole bunch of different other indicators that are not based on the instrument that you're freaking trying to figure out. Like, I don't know how hard it is for people to understand. Like, if you want to know what the market is doing, look at the freaking market. Don't look at the bond market. If you want to know what the stock market is doing, don't look at the bond market. If you want to know what the bond market is doing, look at the bond market. You want to know what the put to call is doing, I don't even know why you'd want to, and I'll tell you why. Okay, so and I didn't always feel like this. In fact, I used to lean heavily on those, but also so there's also the bull bear one that we have there, where this is newsletter survey. So people ask newsletters like, okay, what are you bullish, are you bearish? And the concept is the crowd is normally wrong. So if it's excessively bullish, that we should go down. If it's if everyone's bearish, then we should go up. And it's just freaking silly on so many levels, and I'll get into that in a little bit why. And then a margin debt. Well, let me just tackle margin debt for a second while I have this. And I know this is on our website, and I used to use this type of stuff, and so things change. Like, think about margin debt historically. And the concept is, kind of like when you get excessive, amounts of margin, the market, let me stop sharing. Like everyone's already in there, and then when it's excessively low, then then you could, all this cash is on the sidelines, and that could be deployed. And this goes the same for all those measurements of, like, cash levels. There's a million different secondary indicators out there, and I know this is going to be probably as controversial as me saying I don't use volume, but after I explain this, hopefully it'll make a little bit more sense to you. So, so the margin debt, for example, well, think of the data. Is that data clean? No. How is it clean? So the amount of margin debt that you have, regardless of how you calculate it, you can calculate it however you want. Let's just say it was, everyone, hedge funds, individuals, whatever, and just how much margin was out there, just as a ratio, let's just call it, or total level. Well, you've got inflation, right? So if it's a total level, inflation is increasing each year. And you just think about it, what a dollar is worth now versus a dollar 2 years ago versus 20 years ago versus 200 years ago. It's always, moving up. So you'd have to adjust it for, CPI or PCE, or, find out what real inflation really is, and use that. But let's just think of it as a ratio to, of just cash versus margin. Let's just do it that way. Well, things are different now, because now, rather than, the thought is using a lot of margin is you're using a lot of risk. Well, now you can do inverse ETFs, right? So you could have an account on margin, but you've got SQQ. How is that excessively bullish? That person is bearish. Or let's say, instead of, they're bullish, but instead of buying the Qs and going 200% long on the Qs, let's just use extreme things. They or instead of 100% long the Qs, they go 33% long TQQ, because it's a 3X, or a UPRO for SPY instead of spiders. So just those alone, or individual stocks now have like tracking ETFs that you can do like 1.5 or 2X. So that changes the dynamics. Now you've got daily options, weekly options, so people can hedge themselves. So maybe you're in deeper and you've got a lot of margin, but now there's a way to hedge yourself that you wouldn't have had years ago, because back in the day it was just, like the options were just on the kind of the big companies, and then they were on, quarterly, and then they went to monthly and weekly. Now it's daily, and who knows, maybe they figure out how to do it on a minute basis. I don't know. It's silly. So you've got all this money out there that's really kind of just chasing risk, but in another way, it's chasing reducing risk, because you can hedge yourself that way. So how does that even make sense to use dirty data? So then you're going to use the margin data and say, okay, it's super high, so you're going to take whatever action, and it's slow. Like, it's stupid. I'm sorry. Like, on what planet are you living on? Think outside the box. I don't mean to be mean, but it really frustrates me, because I see a lot of smart people using these things. And I think, frankly, not a conscious level, but it's a subconscious hedge, because it's really embarrassing when you make a market call and you're wrong for most people. I don't care, because you know what? The best people are going to be right 50% of the time. And they're not going to be right 50% of the time all the time. They're going to have times where they're right 80% of the time, and the times they're right 20% of the time, even the best people. And I've seen that with everyone, and I'm no different, but people a million times better than me, they're not right all the time. And so anyways, when someone's making a public call or even just a personal call, they want to hedge themselves. Well, I'm bullish, but these indicators say this, or I'm bearish, but these indicators say this. So you can hedge yourself. So in the future, you can go back and say, well, I did spot out that the margin debt was high, and we did collapse. But yeah, you also said 15 other things that were bullish. So make a stand, like be bullish or be bearish or be neutral, but don't use like something else to measure what you're trying to figure out what the market is doing. You're not trying to figure out different ways people are taking on leverage. So anyways, I got off on the margin debt thing. So the same thing with bull bear, right? So let's just talk about the bull bear for a second. You have different people writing newsletters. So how scientific is that? It's like, okay, we've got different people now with different talents than they had last year and the year before and the decade before that. So it's not even a control. And even if you had the same people, like Bill O'Neill in 1963 was completely different trader than he was in 1969. And he was completely different than he was in 1978, and then in 82, and in 86, and he was certainly completely different in 1990 and 1991. And then in 98, he was different than he was in 2002. I know because I've studied him. So, and I've studied all of his trades. And so he's changing. So even if he had the same person, they're changing. And I know myself how I would have traded in 1997 versus in 2003 would have been different than how I traded in '07 or in '09 or 15 or now. So you've got these newsletter writers that even if they were the same people, which is not the case because people retire, people pass away, and stuff. So it's apples with oranges, with tangerines, with kumquats. It's just it's stupid, 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 stupid. So and it's kind of negative because you're trying to say the crowd is always wrong and all that stuff. And, whatever. Was another one. Okay, the put to call. So I was obsessed with the put to call, and so was Bill. And he didn't have it on his machine. So we would have it in the newspaper at the end of the day of where the closing value was. Again, just a ratio of puts to calls. And again, that's so problematic because, well, what type of puts and what type of calls and what's the true, how much risk are you taking? Let's say, if I want to go out and buy a bunch of puts, but they're, kind of cheap puts versus calls that I'm, going out of the money with those or in the money here or vice versa. Like it's different. So you're dirtying things up just to try to keep it simple. It's like you want to keep it as simple as possible, but you want to do it in an intelligent fashion. Remember what I've always said, like the old Einstein thing of make it as simple as possible, but not any simpler. So you really that's just you would have to figure out a way to create the same type of risk profile for your puts and your calls and measure those, and then you might have something there. There might be something there, but at least how we do it now, or how we've been doing it, just does not make sense. So rewind, I don't know, maybe 20 years or something like that, or maybe even more. And put the call was the one that changed my mind on all these, because I used to use these secondary indicators all the time. Like I said, I'd lean heavily on it. We used to get a weekly detailed email from the bull bear stuff, and I would look at it and study it and think it was worthwhile until I really put deep thought into it. And I haven't looked at it since, and I kind of laugh every time someone brings it. I'm sorry, man. People do a lot of deep thought. So put to call. Bill was obsessed with it too, because we thought it worked really well. But that's what your mind plays tricks on you, because you remember certain things when, the put to call was 1.2 and then the market turned. It was more on the extreme when it got higher, where you got a lot more puts. So it was more of a bottom call than anything else. So, it got to extreme level up. So then the theory was everyone had already bought puts, so everyone was protected. So then the market is going to lift, because if you're trading, and you always want to think through this whole thing, if you're trading and you've got puts protecting your account, well, you're going to be more aggressive with your longs because you've got a floor there. And if you don't have those puts in there as a hedge, then you're going to be more timid, right? So the concept makes sense. And all these concepts make sense. Like everyone would be like, what do you mean? I can hear it now. What do you mean the bull bear and blah, blah, blah. Think about it. So don't trust me. Do the study that I'm going to talk about. So Bill would call me up because I had the put to call real time on my trade station, and I didn't, and we didn't have it in Wanda in real time with Wanda, which was our market surge thing. We just had an end of day data. So he'd call me up, Mark, what's a put to call at? And then click, just hang up the phone, that was Bill. And he would call up several times throughout the day, and then we talk about it sometimes, or then sometimes it would lead on to other conversations. But lots of times it's Mark, what's put to call? And then so I'm like, you know what? I'm leaning so heavily on it that I wanted to do a full study. And when I do a study, I like to do it hardcore. I don't do a small sample. I do the whole thing. So I went and I got all the put to call data, and we use closing values only because it swings so much during the day that if you use the intraday volume or the intraday data, it just makes it even dirtier and trickier. So I was using it, and I went to the very beginning of when the put to call first came out. And at that point, I mean, I spent forever, and I would just pull it up and just without hindsight, I would just say, okay, put to call is here, and we're trying to find a level. And at the time, I wasn't trying to disprove it. I was trying to figure out, because we were moving the level around from like 1.1 to 1 point, which means more puts. 1.0 means you're in balance. Puts to calls, anything above 1, you've got more puts. So it was like we were trying to decide, is the key level 1.1, 1.15, 1.2, 1.3, whatever. And so we were going back and forth. And that's why I did the study. And so I would go through and I'd say, okay, it spiked up to this level. And I pull up the chart and go, okay, what would that tell us? If we acted on that, what would we do? And then I would look at the chart and then make my notes on it. And then I go to the next time it got up to a key level, and it did that. And I did that. It took me, I don't know, months, and I got deep into it. It wasn't just in a spreadsheet. I pulled up the charts. There's a benefit to doing spreadsheets and back testing and things, but you have to do a combination of actually looking at the data. You can't just run something and without looking at it, because you need to be able to trust your instruments. And that goes to a core thing that I have. I mean, so my father was the air traffic controller, and he was the officer in command. I think it was a ATC OIC, down in Tustin in California, as well as El Toro before he retired. And sometimes I'd get to go down there and go in the radar room or go up to the tower, and that was some just not a lot, but enough that it really made an impact. And I wanted to be a pilot until found out my eyes were bad. But just being around all that, it had a lasting impact. But the pilots, they have a checklist. And I remember there was I think it was an Army pilot. I think it was a helicopter pilot. He wrote in a letter to Bill once that said that the system, he was learning the system, and the system made so much sense to him that it's just like kind of like a checklist, and that you've got to follow all the rules, and trust your instruments, if you want to live, in a helicopter. And Bill just loved that letter, and he would bring it around to everyone, like everyone in the firm, like, look at this letter, and this guy is so right. And he was right. It's like, you need to learn to trust your instruments. And that had such an impact on me, because I'm like, yes, every single thing that I use, I want to be able to trust. And this was where then in the back of my mind, that the whole thing with volume started coming, and I started questioning everything. And I'm a purist. I'm a price purist. What do you know for sure? You know what the open is, what the close is, what the high and the low is. You don't know anything else for sure. So going back to the put to call, so I want to be able to trust this instrument. So I'm studying it. And what I found was, for the first, and I don't remember when it started, but for the first like 10, 15 years, it worked really, really well. It was solid. And that's why lots of times these indicators work, because at first they work. And then once everyone starts using them, lots of times they stop working, or you have to adjust and adjust the rules. And so I went through, it was like the first half worked like it was so good. When it spiked up, that was pretty much the low. And if you just bought that, no follow throughs, no 21 days, you were pretty much golden most of the time. Then it became noise, and it was just random luck. And you look at it on the chart and go, that doesn't even make sense. I wouldn't want to buy there. And so I printed off all this stuff and sat down with Bill, and I shared it with him. And there was it was solid. Like, if I did research for Bill, it was solid. Like, these videos are freaking train wreck, man. I'm a perfectionist when it comes to stuff. And this is like, kills me how bad they are. But anyways, I'm just doing my best. So he looked at it, didn't question anything, because he knew how I did my research, and we went through everything. It was clear. Stop using the put to call, because it was now worthless. It was just noise. It would help you as much as it would hurt you. And so I shared it with him. I was a little bit nervous to share it with him because it was something that he really believed in a lot, like a lot, like, a lot, enough to call me many times during the day just to get the number. Um, and we offered to put it on his machine, but I think he just wanted to call me. And he had a habit of calling at really bad times in the market, and it was funny. And he would do, like, if he didn't get a hold of me, he'd get a hold of Chuck or another PM. And it was like, when the inner day, when things were falling and you're trying to decide what to sell, he would call you, and then you couldn't trade because at that time we would call our trades into the trading desk, to the O'Neill trading desk. So when you're on the phone with him, you can't place trades because you can't put Bill on hold. Say, Bill, hold on, I got to, even though it's his money, just, it was rude. So you couldn't do that. So you're like, oh shit, he's calling, and like, I'm about to place a trade, but you got to pick up the phone. So then he would talk. He was notorious for this. He would keep talking until the market stopped going down and started turning up, and he'd go, well, I guess we lived through that one. And then, but the whole time he would be super, super negative, and it is kind of getting his emotions out. So then I would have to have a Bill filter on, because he was human just like anyone else. Like when the market, the intraday chart is looking bad, he was a tape reader. He would look at 5-minute charts, and so he would be like, you could hear the panic in his voice, which was nice, to hear, and because it meant, wow, he's human too. And then the world's coming to an end, blah blah blah, and then the market would firm up, and then it'd turn up, and it'd be like, well, I guess we got through that one. Click, and then you're like, oh, I guess that worked out. I did, like most of the time it would help. It would end up helping you out. And for a while, I thought maybe that was his way of keeping us from selling during the panic. But no, it wasn't. It wasn't at all. It was just his way of, he was just emotional too. And it helped him to kind of get those emotions out, which, most people wouldn't see those, because, he was a different person in public, and, which is fine. But anyway, so I say that is that everyone's human. And then 2, if you have a sounding board, use that. That might help you. It certainly helped him. It messed us up, because then you would still be thinking of what he was saying about all the negativity, so it would take a while to get that out of your head. So I share with him this whole put to call thing. And it was just clear. Doesn't work anymore. And I'm like, okay, I'm not going to get those phone calls anymore, and we're going to move on to, the next thing to test. I kid you not. Like the next day, he calls me up, Mark, what's the put to call? And granted, at this point, this was long before he retired. So he was 100% together mentally. So he just didn't care. He fell back in the groove of his stuff, which is another thing of saying, this kind of fine. Like, I don't understand, like, how he could, like, if he would have questioned some of my research and said, well, Mike, why don't you try it this way, or use this threshold, or tweak it, I would have been totally open to that. But there was nothing to question. It was just black and white. It was like, it's noise. It works sometimes, doesn't work other times, but people remember the ones that worked. And then, I'm sure everyone right now is like pointing to their, I see that the put to call hit a spike here and we never went lower. Yeah, well, go back and do this whole study. You'll see, maybe you'll learn something. And maybe it started working again after the last 15 years or so. But that's when I really started reevaluating, because I thought the put to call was the best out of all of these secondary indicators. And then the bull to bear, I started really doing deep thought on that. And then the same thing with like the VIX, because I know everyone's obsessed with the VIX. And then we had that VIX Armageddon that happened. And so when she started getting instruments off of it, and then when everyone knows and looks at it, you don't think that there's some hedge funds with some algos in there that are trying to manipulate what the VIX is to arbitrage that somewhere? Come on, man. billions of dollars are at stake. You don't think that they can figure out a way, they know how to dirty that up and then benefit from that? I mean, come on, Wall Street is a dirty place, and I might be clean, and Bill was, we're both super clean, but there's a lot of people out there that aren't, and not pointing any fingers at anyone in particular, but just that's the way it is. And so the VIX, the same thing. Is like I see people and they're like, oh, when it gets up to 36 or it gets up to this or whatever, that it's a signal. But go back in time and don't look at the chart. Do a change date on the VIX. So you don't know where it's spiked. So let's say it's running up to like 36 or on its way up to 70, like one of those rare spikes up. Go back to whatever threshold that you're going to use for your signal and say, okay, every time it gets to 40, you're going to buy. Okay, then go through and do a change date there, and then look at the chart and just say, okay, are you really going to buy there, and how much are you going to buy, and what is your, if that VIX goes from 40 to 50, what are you going to do? Are you going to buy more? Now you're going to average down. Now it goes from 50 to 60. Are you going to buy more? 60 to 70, you're going to buy more. At what point are you going to say enough is enough and I got to close out this trade? So that's one thing. There is like tactically, how are you going to do the trade? But then go back and look at it along with the chart and then see how many false signals it gives you. And you don't really know what that level is, because if you look at a chart, historically, your eyes go to the spikes. In fact, let's just look at one of those. Oh, I just remember I forgot to do this. This is my little thing. I do. This is the time I forgot, I guess. I'm starting, guys. Okay, that's an inside joke for anyone who's watched these in the past. So let's see, 0 VIX. Okay, so you get these spikes up all the time. So go back in time, and this is on a weekly chart, and tell me, let's go to a daily. So let's say, like right here, okay, it's 28, but and it's spiked there. On that day, aren't you going to think it's probably going to go higher? Like, and if not, why not? And if that wasn't the case here, like here on August 2nd, wouldn't you have thought, that closed mid-range there? Wouldn't you have thought that had gotten high enough? Let's go back in time. Let's see how far back does this go? Okay, that's 2000. So we've got it going back quite a ways. I don't want to go back that far. Let's go back to, let's go back to 09. Okay, so here on October 28th, it hits a spike. October 28th or 24th, 08. So we will go there. October 24th, it hits, as my better half telling me I better wrap this up. This is the first time she's ever come in, so I guess that's all right. Let's see. And I did record one of these on Thursday night because I know that there's going to be a weekend and I'm going to be tied up, and so I'm still exhausted from that. Okay, so here it hits the spike. So you're going to say, let's say you don't know that it's not going to go higher, but here it is as a spike. And wouldn't you have thought that this would have been a spike here? Because I thought, that was high enough. Now let's look at the market. Okay, NASDAQ. Okay, so you're buying here, October 24th. Now let's just go out, because we know. Let's go out there. All right, so how's that working for you? October 24th. There. I mean, come on, guys. Really. I mean, and just go back and go back and study this, and, because I know so many smart people, like really smart people, just spend a lot of time on the VIX, but just go back and study it. And then if you find something that works with some solid rules, then go ahead and use them, go with it. But it's the same thing for all of those things, and or even these silly things that everyone I know uses. Let's go back to it. Do a change date to current. And I used to use these things all the time. Where is it? Pull this up. Report market indexes. Yeah, down over here. I was looking at this earlier. Okay. So so little things like this, like an overbought, oversold. If you want to know thoughts on overbought, oversold, get Bill's book and read in the M chapter. What does he say? Like, there are two dangerous words or whatever. And here, I got to stop this. I did bring this out because I was thinking about sharing. I was going through my Bill boxes and I found a couple of these. So this is Bill with his PMs back in the day. Can you see that? Yeah. Okay. That's Bill there in the center, pointing the finger there. Let's see. Let me go out further so if you can see that. Okay. There he is there. There's old school stuff, man. And then there he is again. Same photo op. All wearing the suits. He's on the phone there with his old PMs. And so he talks about how in the late 60s, he had a technician who had all of these indicators that he used that, and I was going to share mine, like my Webby RSI and my Bob Marley off high and this other indicator that I have that's ATR based, but we're 2.5 hours into it. And so I'm not going to do that today, especially when my better half's asking me to come eat. Anyways, that, so one of those, I think it was one of those guys, or maybe it was a different one, because I think that's around that time frame, that he had warned all the PMs that, the market was oversold. So it was getting in this thing. It was too late to sell. And then they got killed, I guess. And so he never forgot that. And so he wouldn't use those like overbought, oversold indicators. I don't really, frankly, know how that even got into daily graphs, because he was or daily graphs back in the day, which turned into Market Surge, or Smith, and then turned into Market Surge, because we'd like to, update the names for whatever reason. So that's the overbought, oversold one. So I would never use that. But I did used to use things like this one, the 10-day moving average in blue, and then the pink one, or the magenta, is the down volume. And back in the 90s, this worked really well, but volume was clean back then. And I used to use this. This was my favorite indicator because it worked really well. And I had different things, like when it would cross a certain way, I'd get long. And then when it would cross back the other way, when the blue one started going back down and would cross through the pink one, like right here, that then I would reverse things. But the thing is, as I've talked about in some of the other ones, I don't use volume. So I'm going to use this one. So, because I think volume is dirty. Then you've got this new high, new low thing. Oh my God, man. Okay. So let's just think about this. I was going to break out the different industry groups, but I don't have time for that. But think of it this way: the number of new highs versus the number of new lows, and how dirty that is. So let's take an industry, because it really depends on what industry is moving and how many stocks in that group are moving. And this is not market cap weighted in any way. There's no importance. It could be a $1 stock, or it could be a 2-penny stock, or even if you were to say, on a higher parameter, still, I guess if you were going to do it, maybe you would do it of just the S&P 500. That might be a little bit more meaningful. But the thought process is, when you have a lot of new new lows, the market's bad, and you'll have new highs, or if you want to look at it from a contrary indicator too. But people fixate on this new high and new low stuff. But think about it; it's not bad, you know, be, because in concept it's just off the price, which is clean data, but you're not doing like apples with apples. Let's say you're in a really good environment for biotechs. Well, there are a ton of biotech stocks, so you're going to have a bunch of new highs in bios, right? But let's say you're in a but autos, auto manufacturers, which is a very small group, meaning number of stocks, not by market cap, but number of stocks versus, let's say, large groups like oil and gas, or there's a ton of oil and gas, tons of regional banks. There's a ton of insurance companies, ton of REITs. You can look at we have our list in there, and it has like the number per group. But like I always think of it kind of the extreme or the biotechs, because you got so many biotechs there. So if you're in a hot biotech market, that new highs is going to be artificially inflated, right? Because in general, if the group brings everything up with it, which it tends to do, you're going to have a lot of new highs, but that might not be what the market is doing. Or let's say the biotechs are getting killed, but you're in a bull market, but it's just out of phase because let's say the government is going to start going after bios for whatever reason, and then they're hitting fresh lows. And let's say you have 600 bios, but you've got like three main other, you've got your mega cap stocks, that your mag 7. So you got 7 stocks there, and then you've got 500-600 of these other ones, and they could be hitting fresh highs, and those are all hitting lows. Or the small caps, you have so many more small caps, and those have been out of favor for a long time. So all this stuff is dirty, 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 dirty. And again, it's just a way to confuse you, because if you are not just looking at the price and volume, I mean, it's hard enough as it is with just the price and volume. Imagine if every one of those days that we went on, we also looked at the put to call, we also looked at the bull bear, we also looked at the VIX, we looked at this NAAIM, which I guess people like because it's real money. And my understanding of it, and I could be wrong because I'm not an expert, I Googled it for 5 minutes because everyone's fixated with it. But I guess it's, from my understanding of it, could be all wet, is it's a bunch of fund managers, and they report in there like once a week of how deep they are, like, are they 200% long, 200% short, or anywhere in between. But that doesn't tell you anything, how deep or how long they are. Again, that goes back to, I could be 200% long, Coca-Cola, Johnson and Johnson, a bunch of these other little slow pokey stocks, and that risk in a bunch of banks and really low ATR stocks. Or I could be 50% long Palantir, and which one is taking more risk on? So you're trying to say how deep in these things are because they're real money. It means something more than a survey. I heard someone say that. I'm like, that is just. I'm sorry, I don't mean to be mean, but I just, like, people don't think through, like, it's just because everyone else uses it and it's okay. Maybe it's because I was around Bill so much, and he did not care being off the reservation from everyone else, because his stance on PEs not being relevant for picking growth stocks was so anti everyone, even to this day. But he was like, no, he did the work and he studied it, and that's what he believed, and he, he didn't care what other people thought. And so I'm just trying to help you. I mean, this is not going to win friends or influence people, that's for sure, because I know everyone uses it, and everyone's probably like, well, I don't agree with them. Well, if you don't agree with me, study it, and study it the right way. Don't use hindsight and say, I know what you're going to do. You're going to pull up whatever your favorite chart is, and you're going to go to the extremes and say the extremes that line up properly. But go back and find the other extremes where it didn't work, or do a change date. And then, so all these things confuse you. You're going to look at margin debt and you're going to be confused, and in all these other indicators. So I've got a lot of indicators, but they're all based on the price action. And so how is it versus its 21 day? How is it versus its 10 day? How is it versus its, the volatility of itself. Like, so I'm comparing, how is it versus what the S&P is doing with the relative strength? And so be at least contemplate being a purist. If you want to use all this other stuff, that's fine, but just, you're going to be confused. And that was Bill's thing, is like every one has like 30 different indicators that they like to use. So if you're bullish, you're going to find all these things to point to make your case. Like, you don't need to make a case. It's like you're bullish because the chart looks like it's looked in the past where it goes up. And if you're bearish, the chart looks like it does before it goes down. Like that should be the thing, not all these other things, unless you can prove it. And try mixing all of these things and try to find get a real signal. Use the bull bear, this NAAIM, put to call, VIX, you name it in there. And my favorite one, and I'll end on this one, is the bond market. So, yes, the bond market is super important. Yes, interest rates are super important. Yes, I understand. Oh, shoot. It's my daughter. Just hold on one second. I gotta pause this. Let me see. Where's stop? All right, I'm back. That was my beautiful, wonderful, perfect daughter. And did I say she was perfect? Yeah. And so is my son, but they're just perfect in different ways. I got very, very lucky as a father. So what were we talking about? So we were talking about I forget, but we were talking about all the confusion with the different indicators. So talking to her kind of melded me out. I was getting a little bit upset with this whole thing because it really drives me crazy that when people do this, like, just keep it as simple as possible. Yes, it makes you feel smart if you've got all these different indicators. Oh, we were going to talk about the bond market. Yeah. So the bond market, yes, super important. Thanks for reminding me. You're probably yelling at the screen. You were talking about the bond market. I would have been saying that. So raise your hand if you would have saying that. So I think at least one person raised your hand. So the bonds are super important. Look, I was an econ major. I understand. Like, I get the whole thing. Like, it's the cost of money, and it goes into the discounted cash flow analysis, and everything is so important. Mortgages, auto loans, and of course, business loans, the cost of money and venture capital. Like, it is a big deal. But the concept, and this isn't my concept, this is Bill's concept, is that the bond market, everything that's going on there, which there's huge, massive, the biggest market out there, that and currencies, that's all, and the same thing goes for currencies, that's all reflected in the price of the S&P and of the NASDAQ and all of the stocks, because people much smarter than all of us, and this was Bill's concept, was people are so smart that they are going to look at all of that, and that is going to determine. So it's, you really wanted to look at the instrument itself. So I can tell you that in all the time that I spent with him, there's only one time that he ever brought up the bonds at all. And it was when we were working on the newspaper, and he was trying to find space in the newspaper to put something. He was trying to figure out what he could remove. And then the only thing that was there that he wanted to remove, we had this little yield curve in there, the yield curve where it shows like short-term interest rates versus long-term. And there's this whole thing. Oh, inversions. Remind me to talk about that. So he wanted to remove that, but then he got flack because people like that. But that was the only time that he ever. Now, if he was a bond trader, that's all we would have been looking at were bonds, not the stock market. Even though the stock market impacts the bond market, but you want to just keep it as simple as possible. So I'm a purist. So I'm orthodox in that fashion. I'm just price, high, low, close, clean data. So the inversion. So what year was it? Maybe 7-8 years ago or something like that, where the yield curve was inverting and everyone was having a cow about it. And I was getting worried because you hear all this stuff, and you're like, the bond market guys are always supposed to be thought of as the smart guys, and because they tend to be. And we're kind of like the gunslingers, and they're like the the math stats smart dudes, and that's cool. And but there was this whole thing with, okay, if, you know, yields invert, then it means all this for the economy, and then therefore the stock market. So I said, wow, that's a big deal. So I went back and I did the same thing I did with the put to call, and I went back and I did every single time that the yield curve inverted for the very first time when it hadn't been, and I pulled up the market and I looked at it, and then I, you know, did the same study and came to the same conclusion that it was just noise. Yes, I got what it meant. There was significant, you know, for the economy and everything, but sometimes the lag on the way in, before it happened or after it happened, the timing of it was so late that just the inversion of it was not the right signal. Now, there might be a signal there like early on, you know, because I didn't study it that way, or like using moving averages and things. There might have been something there. But at least with when it actually inverted, because what would happen is people would then go, no, no, it works. And then they would point all these times. I'm like, yeah, but look over here. Oh, it only spiked up for a little bit. Well, you didn't know it only spiked up for a little bit at the time. So then are you going to put a lag on there? You know, and then how much of a lag? You know, like how I use the low above the moving average for 3 days or whatever, you know, which you could use two, but then you can have more whipsaw. You could use 5 days, but then you're going to get in later. So you got to find your sweet spot. So what is it going to be? But no one really had an answer. So then I stopped even looking at it once I realized and did the research, and everyone was hung up on it. And then the yield curves did invert, and in the market, stock market went up. So all these people, and then they stopped talking about it. Or like with the bond market, you know, they just say the level of it. And I got, you know, someone was trying to be very rude with me, frankly, about the bond market when I was saying, you know, a few months back, maybe 6 months back or something, you know, that I didn't use. And they're like, oh, what, the cost of money isn't important? And well, I think it's important. And I'm like, okay, well, and they were, you know, because the market was down that day and yields were up, and they're explaining why. Well, lots of times people explain why because you have to have a news story. Like CNBC has to have a reason. Sometimes markets are just moving because they're moving, because they're nothing is just static. Everything's always moving, and it's like a trend that already started. And you know, but people are always trying to point to things, and so they're like, oh, the, you know, yields are going up, and then when the, you know, I didn't hear that person talking about it when the market was going up, and yields were going in the other way. So people pick and choose. So don't do that. Don't be that guy. You know, look at the instrument, or at least think about it. Like, be open minded. You know, be open minded to it. And if you think that I'm all wet, that's fine. But do the work. Don't just because everyone else says that, and just because I say it doesn't make it true either, because I did the work. So going back to that fighter pilot, you know, the helicopter pilot, he trusted his instruments, and so I trust my instruments. Are they right all the time? No. But are they going to keep me wrong for long? No. You know, because I know where my exit is on each one. So that was that. I had more to go over, but it's way too long as it is. So we're going to switch gears here. We're done with stocks, and we are going to talk about, who do I have today? We've got one of the greatest bands of all time, and certainly way better than the Beatles. I know that's going to piss some people off, but it's true. The Rolling Stones. Rolling Stones are one of my favorites. Of course, you know, Keith Richards is like up there, and he's so cool. I mean, he might not be the best technical guitar player out there, but man, who's better to listen to and watch than Keith? He's having a blast all the time. And what is he, like 80 now? And he's still going. But we're going to just share with you. And again, at the end of all of these, if this is the first time you're with me on one of these, shoot, I got to open up my, let me see, open up my Spotify. Go to the Rolling Stones. Let's share this. So at the end of these, I always just kind of want to share some music with you guys, because I talked about, who did I talk about? Forget who it was, but they're like, oh, I'd never heard of Tom Petty before. I'm like thinking, wow, everyone, and it was someone else too. like, wow, if people hadn't heard of Tom Petty, like maybe there's lots of other stuff that they hadn't heard of. So at the end of each one of these, I just want to kind of point you in the direction of some music to check out, because that's what I'm interested in, frankly. So we're going to go through and just I'm going to just point out like where with the Rolling Stones, because you obviously have all heard their best song, right? And what is their best song? That's a good song, but that's not the one I'm thinking about. What is their best song? Sympathy for the Devil is a great song. One of their best. I'd call it their second best, but Honky Tonk Women, that is their best song, and that is just a fact. I've done this. I've done the study. Don't argue with me. All right. So let's just go through some of these albums here. Now, their old stuff. Let's just do just albums. Their old stuff is so fascinating. So this is their first thing back in 1964. So you've got, good old blues stuff like I'm a King Bee, think like Muddy Waters and things like that, or like the old Route 66. If you've ever watched Cars, my son was so into Cars, that movie, that old one. But Carol, that's a old, Chuck Berry tune, or Walking the Dog. I know my buddy played that in his band, Bob. And so some old stuff, but this is, if you listen to this, is not what you're going to think of when you think of the Rolling Stones. I'd say really the Stones wasn't until really kind of like Let It Bleed in '69 where it really got into like the best phase of them. And like Give Me Shelter is such a great song. Love in Vain, a Robert Johnson song. We talked about that when we talked about Eric Clapton. You've got the Silver, a great one, but you can't always get what you want. One of the best songs that they've ever had. Oh, wait. Forgot their Rambling song, Midnight Rambler. So I guess that's me when I'm talking late at night. Sticky Fingers, another great one. That's got the Brown Sugar, Wild Horses, can't hear me. God, so many great songs. But if you're Exile on Main Street, oh my God, that's such a good one. Too, Tumbling Dice on there. I mean, geez, it's so many great albums. But where I was going, I wanted to do their best of. It was their not seeing it down there. It was their best of their early stuff that they had. Oh, the Steel Wheels was that. Now that's a little bit different. That's their newer stuff. But what they did is they went full circle back in 2016, and they went and put this blues album together, Blue and Lonesome. And I would suggest, taking a listen to that one. That one's a really good one. Okay, Live at the Checkerboard with Muddy, and so the Checkerboard, Buddy Guy's place. And before you had the Legends place. I don't know if I told the story about the Legend, but I can't do it today. But funny thing about Muddy Waters, and I'll end it here. So obviously they named their band, the Rolling Stones, after a Muddy Waters song. And if you don't know who Muddy Waters is an old blues guy like B.B. King, and is thought of as one of the you had early on, you had Robert Johnson, and then the other two biggies, would be, BB and Muddy. And so they really liked him, and they liked the old blues guys. And so they were over in England, obviously, and they came out here to record at Chess Records, and recorded some great songs there. I think for their early on, like their second or third album or something. And they go in there and they see, and I hope I'm getting the story right, is they see Muddy Waters and he's painting the ceiling. They have him painting the ceiling. So here's this guy who's like, this great guy and thought of and revered by all of us. But because it just blues were out of favor at that time, they had him painting his ceiling. So I always kind of like um, can relate, in some weird way of like, well, that's a different topic, but it is just funny. Like, those guys got, their intellectually property they got screwed on theirs too, because everyone, made money off of their stuff. So you get, Rolling Stones and everyone playing their songs, and it is what it is. At least they get some money flow back. But so the Rolling Stones, if they're go out on tour in your area again, you got to go see them. The last time they were out here in Austin, I couldn't go. One of my family members was flying in that day, and I just could not pick them up to be at a Stones concert because that's not cool. But hopefully, I get to catch them again because they are as good as it gets. And my sister's a huge Rolling Stones fan, and she goes and sees them, and she's seen them more than I have. I think the first time I saw them was the Bridges to Babylon tour, and oh my god, that was amazing. They had, I think it was at Dodger Stadium, and they had their huge stage that they always have, which they go over the top, and then they had this bridge that came out to the middle of it to like where the infield was, and then they played this little thing without any frills, with just the original band members, or just like the guitars, the bass, and the drum, and, you know, and just played some of the songs that way. And then they went back over the bridge, and then they did their full thing. It's really quite fascinating. So it made you feel like, even though you're at, I think it was Dodger Stadium, that they had this, that you were there seeing them early on. And the last time I was at Dodger Stadium was actually at the Guns N' Roses show that I saw with my son, when they reunited with Slash and Duff. And oh my God, that was probably, besides when I went to the Sphere and saw Dead and Company with them, that was probably the best concert experience that I'd ever seen. So if Guns N' Roses are in your town, you've got to see them. I mean, they put it all out on there. They do their shows as long as I do my podcast. So with that in mind, you go and you be kind to somebody out there, and that is your tuition for today. And please be careful. And I hope this helps. And please go, if you haven't watched them, watch the 21-day and both of the follow-through day videos, because I think it'll really help you. And just remember what we learned today. Go back and listen to it again. Go to those dates and go through them slower. Take notes, make some original observations, and you'll probably find a lot of things that we didn't talk about that we didn't have time to get into. So hope that was a good one for you. I think it was good. I mean, I tried to keep the rambling on to 51.5% of the time or less. So peace out, guys. Bye-bye.